Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equity futures negative here by 1.6% on the S&P. On the Nasdaq 100, we are down by 1.9. On the Russell, by 2.4. Out of Savannah's this morning, the Fed on the back burner.
What gets the Fed to move by more is financial conditions.
Now what we're seeing is deglobalization. That ties the Fed's hands, and the Fed can't play the hero anymore.
I don't think there's any case for the Fed to cut interest rates.
It would be best for the Fed to be patient as we go through this price shock.
They're kind of in a position where they can't act. They're going to have to wait and see.
So here's the latest this morning. The Fed isn't blinking in the face of downside risk to growth and upside risk to inflation. The former Kansas City Fed President, Thomas Hoenig, looking ahead to the March CPI print due in less than 1 hour, writing, there will be an expectation that if it is favorable and if oil prices continue lower, the Fed should be thinking about an interest rate cut. Thomas joins us now for more. Thomas, welcome to the program, sir. Let's just take a step back. I'd love your opinion, your view on how you think the Fed has conducted itself over the last week. Have they done all the right things?
Well, yes, I think they've done all the right things. They've stayed calm, apparently. At least on the surface, it seems calm, although I think they're very much aware, we're very much aware of the effects of the tariffs, and around that, the risks it had for liquidity in the various markets, especially the Treasury market, as you saw the yields going up fairly rapidly without anyone having a clear explanation of that, and they've kept calm. So yes, I think they've done pretty well this last week. I think their challenges still remain. The tariffs haven't really, the war has narrowed, but we're still in a tariff war, especially with China, and so there's a lot of uncertainty remaining.
Thomas, I'm curious what you think the Fed could have done or should have done should that dysfunction have continued yesterday. And I ask you because there was some speculation that it would have prompted them to have some sort of emergency quantitative easing. Do you think that that type of bond purchasing is a tool that they are really looking at right now in the face of perhaps potentially additional turmoil?
Well, I don't think they're looking at, I don't think they're looking there yet. I think they were watching it very carefully. And I have to tell you, one of the things that you need to think about here is as we have dealt with this tariff and the uncertainties that it brings, it also brings to the front, I think, a bigger issue. And that is the national debt is going to go up. I mean, we have this resolution, we'll have another $2 trillion of deficit, the debt grows. Who's going to fund that? And if the world's saying, well, wait a minute, I can't rely on the U.S., that becomes more problematic for the U.S. and for the Fed, because if your foreign buyers of our debt recede somewhat, even modestly on the margin sometimes, it puts more pressure on the domestic market to do that, and that's putting pressure on the banks. That will then put pressure on the Fed. And it's when that begins to occur, if we continue with the trade war, that I think the real pressures on the Fed will come forward to monetize, that is, buy some of this debt. One other thing I want to point out to you, though, is you may have seen where there is a proposal, and the Secretary of the Treasury talked about it, the incoming Vice Chair for the Fed on supervision talked about it, and that is removing any exempting treasuries from the so-called capital leverage ratio. This is very significant because it means the banks don't have to capitalize any of this national debt. Their cost of capital will be favorably affected. And that's designed to make them more able to buy more of the U.S. debt. That is, a banking industry to buy more of the debt. And then when they put that debt on, the Fed has to backstop that for liquidity reasons. If the interest rates were to shoot up, the Fed would have to be right there. So the Fed's kind of, it's going to still be the backstop, but in a little bit different way.
How much is this the reason why you're hearing from an increasing number of Fed officials a real priority on inflation ahead of even the employment mandate. And Minneapolis Fed President Neil Kashkari wrote a blog post this morning where he came out and said, our first priority must be keeping long-run inflation expectations anchored. And he said, in my view, the hurdle to change the federal funds rate one way or the other has increased due to the tariffs. Do you think that this prioritization of inflation over the employment mandate, over the dual mandate, is what they have to do?
I think it is what they have to do, frankly, because, you know, we've said it for years in the past, that is, you can't have maximum employment without stable prices. And inflation right now is 3%. That's 50% above their target. And 2% inflation is a fair amount of inflation over time. So I think it's about time the Fed refocused. In the 2010 period, they decided to make the dual mandate in the sense of employment much higher, that part of the mandate much higher, and Chairman Powell has emphasized that even more recently, and that, I think, takes the, shall we say, the eye off the ball. They have to focus on inflation. It's not going to come down a lot today, I suspect, when they report it. That's even before the tariff war. So, yes, I think Kashkari is saying the right thing.
How difficult is it to focus on inflation when the goalposts keep moving in terms of the rates the U.S. is going to charge trading partners?
Well, that's the difficult thing, because the U.S., instead of focusing on its national debt and its increase of national debt and the debt that has to be funded, they're starting to fight a war, a trade war, and therefore they've taken their eye off the ball in one sense, made it more difficult for the Fed and for the Treasury for that matter. So they need to get back to, we can solve a big part of our trade problems if we solve our own national debt problem and our spending, our government spending problem, which is a problem. And they're not looking at it, I think, carefully enough.
Yesterday, we had the U.S. Chief Justice letting the President of the United States, Donald Trump, remove 2 agency leaders for now. Are you concerned about Powell and his position?
Well, I think this is a big deal. I think the fact that you can fire board members of an independent agency, you know, the Fed is always thought to be special. I saw where one of the justices said that. But when you come down to law, if they make that decision for one independent agency, people have got to immediately think of what does that mean for the others, and that includes the Fed with its independent board of governors.
What kind of market response, Thomas, do you expect should there be some sort of threat to Jerome Powell and his role as Fed chair?
I think it will be pretty significant, because it clearly says we're going to politicize the Fed completely. And what's going to happen then? That's another source of great uncertainty in the market. And I think it will be destabilizing to a degree.
How much do you care about CPI, which comes out in about almost 40 minutes?
Well, I care a lot about it, because it tells people where are we taking things. And, you know, 3%'s been there for a long time now, more than a year, in my opinion. And it's not coming down. They're going to spend a lot more money. The Fed's going to be under a lot of pressure to monetize some of that. The banking industry is going to be under pressure, especially if they make it easier for them to take on these debt. So there's no discipline to our fiscal side. And the Congress is going to pass another very significant spending and, shall we say, borrowing bill. So, yeah, CPI is going to tell the world where we're headed.
CPI drops at 8:30 Eastern Time. Thomas, appreciate your time. Thoughtful stuff. The former Kansas City Fed President Thomas Honig there, going into the next Federal Reserve meeting. The first week of May, Bramo, not too long away.
Honestly, what are they going to say, given the fact that right now they've played it cool? They've said we don't want to get ahead of our skis, but they have to talk more about what tariffs do. And we are hearing some of that from Neil Kashkari, saying that the bar is a lot higher for them to move either way, which is the first time I've heard rhetoric like that for a while.
If we don't have the trade deals and the goalposts keep shifting, we don't know what the final rates are going to be, how does the Fed take anything into consideration and decide to cut? Because they don't know what the future is going to be. Imagine they moved before Trump's decision yesterday to pull back.
Then they're offside.
Exactly. It's very difficult right now, and the uncertainty is not just pervasive in the business community, in the media, trying to understand what the Trump administration is doing, but it is at the Federal Reserve.
The fate of the economy at the moment dictated by one individual who can dictate how talks go over the next 90 days or so. Equity futures at the moment on the S&P 500 negative by 1.6%. In the bond market, we get a bit of stability after a rocky few days. In the bond market at the moment, yields are lower by 3 basis points, the 10-year 4.30. On twos, we're down about 5 or 6 basis points at the moment, the yield 3.85. The data drops 8:30 Eastern time. In the next hour of Bloomberg Surveillance, we'll catch up with Greg Bowdle of BNP Paribas, Erica Najarian of UBS, Torsten Slok of Apollo, and David Kelly of JP Morgan Asset Management. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance just around the corner.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
I don't think Fed cuts are necessarily the help the investors might be hoping for.
I don't think there's any case for the Fed to cut interest rates.
It can be best for the Fed to be patient as we go through this price shock.
What ends a market cycle is an oncoming recession.
An abrupt start to the third hour of Bloomberg surveillance. Not sure what happened just then, but good morning to you. Equity futures on the S&P 500 negative here by 1.6%. Let's check out the price action and move to the Nasdaq. We're down by 2%. This was the biggest one-day pop since 2008 on the S&P 500. Coming off the back of it with some declines. What's changed? Not much has changed. We still face 125% tariffs on China and 10% tariffs across the board. If you're looking for what's happening right now in the bond market, bond yields at the moment down by a few basis points. We're down 3 on 10s to about 430. On 2s, we're down 5 or 6 basis points to 385. And Anne-Marie, the bond market playing a major part in the back down from the president in just the past day.
It is absolutely. When you heard from Scott Bessent, the Treasury Secretary, and the President, that they've been thinking about this for a few days. The Treasury Secretary talked about the fact that he was at Mar-a-Lago on Sunday. They had this meeting. He came back with the President to Washington, D.C. But then it felt like yesterday morning, and the President talking about the bond market overnight. He said it's tricky, but now it's beautiful. And he looked at it. And apparently that was the final threshold for this president to decide, I need to walk some of this back. We're going to go all in and dig our heels in when it comes to China. But our other trading partners, we're opening the doors. You have 90 days to strike a deal.
Does it put a ceiling on the volatility? Later on this morning, it's going to be about the economic data, 8:30 Eastern time. We get US CPI. That's the next stop for this debate in this market. Inflation data, Lisa, just around the corner.
And how much does it actually matter given the volatility that we're getting in some of the policy? We just heard there from Thomas Honig, formerly of the Federal Reserve, saying it does matter quite a bit to get a sense of where we're coming from. And I think that that will matter, but also what will matter is data like how much foreign buying will there be? How much are people actually buying the bond market when there is volatility in the stock market? And those are some of the data points that might be more constructive going forward about the future path.
Truly historic swings worldwide in the past few days. Coming up this hour, we'll catch up with Greg Bowdle of BNP Paribas as stocks whipsaw on changing tariff policy. Erica Najarian of UBS looking ahead to bank earnings, and Torsten Slok of Apollo reacting to the latest read on inflation. We begin this hour with stocks struggling to add to Wednesday's major rally. Greg Bowdle of BNP Paribas writing, bear market rallies can be very large and violent. A short-term market rally and compression vol, similar to what we saw yesterday, sets up entry points to add hedges ahead of earnings season. Greg joins us now for more. Greg, good to see you.
Good to see you.
Would you describe the last 24 hours as just a bear market rally?
I mean, it has the attributes of it. If you go back through history and you look at what were the largest one-day rallies for equity markets, they all occurred in bear markets and generally not at the end of them.
The president's in control here. He seems to dictate things. Does that make it different?
I'm glad somebody's in control. I think it makes it incredibly hard to navigate. We see that the way things have flip-flopped over the last week. I think anyone who says they have certainty on where the growth outlook is going, where earnings are going, where the tariff picture is going to settle, is probably exaggerating somewhat.
How much do we have a real price check at a time when anyone who tries to short this market is, you know, we talked about this before, going to get their face ripped off based on a tweet? How can you really get any conviction to give a check on any potential volatility?
I think one of the things that we've seen develop over the last couple of years are flows in the equity market that have changed the market structure of how the equity market trades. We saw absolutely massive flows yesterday. Some of that was discretionary buying. There were very large inflows into the ETF complex, but some of it is systematic. There's essentially a short gamma profile in the market, which means there are forced flows when the market has large moves. So we think these systematic flows contributed more than 50 billion of buying flows yesterday. So this is something that amplifies moves in the market, both on the downside and the upside.
This is important. CTAs you're talking about, right? To some degree?
I'm not talking about CTAs. So CTAs are trend following that contribute to the first legs of this sell-off. But what we're talking about is more flows from things like the levered ETF complex or rehedging of option flows.
Okay, so if that's the case, how much does that structurally mean that the biggest tech stocks will keep trading like penny stocks for the foreseeable future? Because if that's the dynamic in markets, that's how you get a $1.7 trillion increase in valuation of just 6 names.
It creates this reflexivity that when you have large moves, say a 5% move, it's much easier for it to snowball into a 10% move, as we saw yesterday, than it would be in another market regime. So that's something that's structural, and it hits there.
So you think the next leg lower is down? Sorry, the next leg is lower.
I think it's more likely that we revisit the lows than we don't. I think looking forwards, things are going to move a little bit from a very macro headline-driven environment to one where we try and distill what is the impact for this. Earnings season is coming up. Obviously, the backward-looking earnings aren't going to be a focus, but the forward-looking guidance and the commentary from CEOs will be.
So what do you do in the next 90 days if everything is headline-driven and they're working on striking deals with 70 trading partners?
I think you have to look for asymmetric opportunities. So the option market is really where we would focus. And it has been challenging because equity volatility has absolutely exploded. But as we get moves like yesterday, when the market rallies, we see volatility come in rapidly. And we think that can give some opportunities to strike hedges. So one of the things you can look at is the implied probability from the option market as to where the market could trade. So for example, if you think the NASDAQ is going back to where it was just yesterday morning by the end of next week, the market implied probability of that is about 10 to 1.
So you have a Trump put and a Trump call. Basically, what are they? What's the price? What's the strike price?
So I think the strike price is less of a market level, and I think it's more a function of volatility when things are breaking. This is also how we've tended to think about the Fed put historically. People will ask you, where is the Fed put struck, thinking that you can think in S&P terms. My view is it's more when things start to become dysfunctional and you get signs of stress in the market, that's when you're more likely to see a policy put kick in.
We're talking about the most liquid, deepest, most traded market in the world. And we're talking about a greater likelihood of a 10% move on any given day, up or down. John was saying earlier that if we were talking about Chinese stocks, we would say almost uninvestable. How much does that change the profile of U.S. markets in a pretty profound way if this is the new normal?
I think it obviously has an impact on people's ability or willingness to put money to work. The anecdotal evidence, though, is that there are still pockets of the market, I think particularly retail, who have this very entrenched buy on dip mentality. And right now the flows tell you that is still what they've done right the way through this crisis.
Oh, you don't think we shredded that at all over the past week or so?
No, I think the anecdotal evidence of that in terms of what we see in flows is that there was dip buying from retail last Thursday, last Friday, and indeed at the start of this week.
Domestic retail, what about international, institutional?
I think it's much more challenging for institutional investors, particularly international investors. And I think when we look at the positioning data that we track, we basically saw that the institutional positioning landscape basically reached capitulation point going into yesterday. And that also, I think, plays a part in the velocity of the move higher.
So at this point, going forward, how much do you see a reduced interest in U.S. equities than you had from international investors? Or is this just a momentary blip? Do you get the sense that maybe this isn't necessarily structural? This is a moment in time that we're going to look back on as, oh yeah, that time, but we've moved on.
It was something where this was already emerging at the start of the year in a more positive than negative way, where people were starting to look at other markets such as Europe and make a more positive case, which definitionally means some rotation out of other markets that are overowned, like the US. So I think at the back of people's mind, there is this idea of this rotation trade can play out. But when you go to markets like Europe, which have historically been more volatile, had fatter tails, tend to have more leverage and lower quality corporates in general, that's a hard thing to navigate in this market.
Is this fun?
It is a little bit, yeah.
Is it really?
I think it's something that if you work in markets, then when you get some of the largest moves in markets, you get massive outliers understanding why and what's driving that.
Tweet or a truth posting.
Off one tweet, yeah.
Yeah, so that's fun, evidently.
You're going to be saying that in a few weeks' time?
Probably not.
Yeah, I wonder. Greg, it's good to see you.
Thank you.
Appreciate your time. Thank you, buddy. Greg Battle of BNP Paribas. Truly historic moves we've seen in the past 24 hours, and one social media post shaking up this market big time, sending equities to a monster rally and attempting to put a floor in this bond market, because the moves we saw in bond yields over the past few days clearly unnerved the White House. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Speaking of those moves from the White House, President Trump is giving dozens of countries a 90-day reprieve from his tariffs. However, China is not one of them. Trump announced a record 125% levy on Chinese goods. The move puts Trump on a collision course with Chinese President Xi, whose government has vowed to fight to the end in any confrontation with the U.S. The U.S. and Vietnam, though, are set to start negotiations on a trade deal. The two sides have agreed to consider minimizing non-tariff barriers and strengthen coordination to prevent trade fraud. Vietnam was among the first countries singled out by Trump for showing willingness to negotiate. China has bought an unusually large amount of Brazilian soy this week. People familiar with the matter telling Bloomberg that importers scooped up at least 40 cargoes of beans, taking advantage of the recent dip in Brazilian prices. It also comes as U.S.-China trade tensions escalate. Soy is America's top agricultural export to China. And that's your brief, John.
Brazilian farmers driving around in Lamborghinis at the moment, that's for sure. Up next on the programme, the morning calls. Plus, a little bit later, we'll catch up with Erica Najarian of UBS, looking ahead to big bank earnings. That kicks off tomorrow morning. Live from New York, you're watching Bloomberg TV.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
We said this yesterday morning, you can't look away from the Bloomberg terminal at the moment. Blink and you miss it. It's a 10% rally. Just like that. Equity futures on the S&P 500 at the moment, negative by close to 2% on the S&P. On the NASDAQ, we're down by 2.4. Just a little bit of stability for now in the bond market. Let's see if it sticks. 10s at 432. At the moment, 2s at 388. Let's get you some morning calls. First up, Goldman Sachs downgrading Ford to neutral, citing weak demand and higher costs from tariffs. Your second call from Mizuho, lowering its price target on Tesla to 375, noting Trump's 90-day tariff pause does not apply to autos. Tesla's down by 3.75%. And finally, Dan Ives of Wedbush cutting his price target on Microsoft to 475, pointing to uncertainty from the, quote, tariff game of poker. That name is down by 1.5% in the pre-market. Let's turn to the big banks. Earnings kicking off with JP Morgan, Wells Fargo and Morgan Stanley reporting first quarter results tomorrow morning. Erica Najarian of UBS writing, management teams are between a rock and a hard place, as any outlook seen as quite bearish could also punish the sector. Erica joins us now for more. Erica, always good to see you.
Good to see you.
What do they tell us tomorrow morning? What can they tell us?
What can they tell us that will matter? A lot of investors are thinking that whatever they'll say, which is actually not so bad, is going to be seen as backward-looking. Now, I think there are really two things that investors are looking for. Number one, are activity levels now just permanently impaired from both the corporate side and the consumer side? So clearly, we had this animal spirits economy that we really wanted to come through. And if you're a corporation, how do you make decisions in this environment, right? And so as you think about investment banking and loan growth in commercial, you would think that has to be at least delayed. Although I wonder if the equity market continues to rally, obviously not today, but I wonder if there's some deals that it's going to get pushed through the pipeline over the short term. On the consumer, you know, American Express is not normally seen as a bellwether report, but given that 10% of Americans account for, or high-end Americans that make $250 account for 50% of the spend, all of a sudden they're a bellwether report, because if they're slowing down, that's that's not good for consumer activity for the rest of the year.
So the banks are the best data points we have at the moment. It's the best real-time data we'll get. A lot of people looked at payrolls and just said that's old news. When you were in touch with the management teams over the past few days, you put together a picture of where things are at currently. What are they telling you about activity at the moment? Have things slowed down?
Things are slow. If you look at the regulatory data and you catch up with the banks, commercial activity, it's slow. It's quite flat. And if you look at the Dealogic data, I mean, it's depressing. The whole capital markets renaissance is just not quite happening. But trading, you know, as you can imagine, given all this volatility, trading could be lights out for this quarter.
Okay, hold on a second. I remember when we used to get volatility, and it was good volatility, and then it was bad volatility.
Yes.
And volatility isn't always a good thing. So is this good volatility or bad volatility in terms of bank profits?
So far, again, you know, speaking about backward looking, if you think about the month of March and think about the equity market volatility, sell-side desks are typically long volatility, so that could be good for them. Now, what makes me nervous is what's been happening to the Treasury market in terms of dealer capacity. So the key question for the month of April is, you know, is there something going to happen? Is there bad volatility now happening in the fixed income markets that is not going to be good news for the second quarter?
So going forward, what do you think is going to potentially be the bigger driver? Is it going to be the trading side of things, or is it going to be the M&A wave that doesn't come to pass, or is it going to be deregulation, which we've seen some of, but not necessarily the full package?
So investors just never really value trading earnings much, right? It's super volatile. It's like throwing a dart on the board. Who knows in any given quarter, right? I think what they're really looking for is, you know, honestly, any signs of credit at this point, because the reaction of banks up until yesterday really told me that investors were starting to worry about recession rather than just a slowdown in activity levels. And so how they frame that in terms of preparedness, having the earnings power to protect their capital, let's say if credit costs go up in anticipation of a tougher economy, I think that's what the market sort of needs to hear for now. On the deregulatory point, what's gotten lost in all of this is I feel like the deregulatory momentum in Trump 2.0 is actually much stronger than Trump 1.0. I mean, we went to that lunch. I mean, he started off, Secretary Bessent started off with bank deregulation at this lunch at the Economic Club in New York, and everybody just wanted to talk about tariffs. And he started off with bank dereg. But for now, until we understand, you know, the range of outcomes for the economy, the macro volatility uncertainty will trump the deregulatory positive catalyst.
But do you even believe these CEOs when they come out and potentially say we're not going to have a recession, or we are? Goldman Sachs pulled their call yesterday after Trump came out and blinked.
Again, rock in a hard place, right? So, you know, if you think about how banks set credit costs, they think about the future, they think about the outlook, and they're saying to themselves, well, I have no, you know, I don't know what the outlook is, so perhaps they're going to build reserves a little bit, but you don't have an inventory of losses that are coming down the pipeline. Card delinquencies are actually flat to down, and commercial delinquent or non-performing loans are pretty flat and improving. And so it's tough, but they have to talk defensively, or else investors will think they're burying their head in the sand.
It's an important point you brought up about Scott Bessent at the Economic Club of New York, where we saw each other last, because he wanted to talk about deregulation and tax cuts, but the entire room wanted to talk about tariffs, because at the moment there was all this uncertainty about what they were going to do with trade. When you take the entire policies of the Trump administration, deregulation, tax cuts, and tariffs, how much more constructive is that for banks towards year end?
So deregulation is super, super constructive, right? Particularly as we start thinking about changes in the stress test, which I think could be a 2026 catalyst. I know it's not 5 minutes from now, as we like. So deregulation, I think, is a big catalyst. You know, tax cuts, obviously the continuation of, you know, the Tax Cuts and Jobs Act would be, you know, beneficial for corporate activity, but that's something that's already embedded, right? It's already baked in the base case. So just extending that isn't necessarily going to pump up activity, which goes back to trade, right? It's like the big overhang that is overshadowing everything else that's good.
So do the big banks benefit the most from deregulation and an uncertain regime where they consolidate a lot of trading volumes?
So I think that in a deregulatory environment, you get to unlock a lot of excess capital. And I think that's great. But if there's not a lot of demand for that capital other than trading, what good is it to unlock excess capital, right? And by the way, remember, buybacks tend to be very pro-cyclical. Like, if we're staring down the barrel of what we stared at last week, you know, I don't feel like bank management teams are going to be like, I'm going to buy back a ton of stock now, right? They tend to be like, well, we're going to keep the capital, you know, tight and excessive for a rainy day. So, you know, we have this regulatory or deregulatory momentum to unlock the excess capital, but we need somewhere to put it. And I'm not sure it's going to be like shoe factories in Binghamton, right?
Do you think there's some pressure on them to cut costs now?
Pressure to cut costs. I think it's too early. I mean, trading is great. No one is giving up on the outlook yet for investment banking. And, you know, especially a lot of regional banks have PTSD from cutting too much in 2023. And now, like, they're, you know, lost some A players, and now they're scrambling to hire even like a B+ player, right? So I'm saying, so there might be some durability in costs. It's too late to use that as a lever.
So
too early, rather.
Looking across the companies that you cover at the moment, just identify a couple that you do like in a moment like this one, because this sounds tremendously bearish at the moment, but I'm sure there's some names you like.
So,
what do you like at the moment?
Counter to everything that I said, I am obsessed with Capital One. I think that, like, so here's the tagline: cycles are temporary, but networks are forever. And buried under all of the Liberation Day chaos on Thursday was the New York Times headline that the DOJ is okay with the deal, right? And this is a once-in-a-lifetime deal for Capital One to own a debit network and a credit network. So in an environment like this, I have no idea what the macro is, or else I wouldn't be sitting here. I'd be on the beach, right? But in that case, what investors will support and like are stories where they can self-start, like, you know, they can, you know, grow earnings power in a different way that's completely exclusive of the macro. And that's what's happening with this Discover deal.
We all want to come to the beach with you. Erica, it's good to see you. Thanks for dropping by. Thanks for your time. Erica Najarian there of UBS, looking ahead to those bank earnings that drop tomorrow morning, kicking off things on Wall Street with JP Morgan. In just a moment, 8 minutes away, you'll get US CPI, the latest read on inflation data in America. Mike McKee joins us now for a preview. Good morning, Mike.
Good morning, John. Well, coming into this, everybody's kind of expecting a little bit of good news, drop in the year-over-year rate of inflation for both the headline and the core. The core is going to get a lot of attention because people are going to want to see what happened in terms of prices during the month of March. We did have some tariffs on. So did they affect particularly goods coming in from China, apparel, furniture, toys? And we'll keep an eye on that for you. And then jobless claims have just been a good news story ongoing, even though we've seen all these reports of layoffs from the federal government. And now we're beginning to see them from companies. So what is the status of the labor market? That's another one to watch, because Fed officials are saying labor market's okay. They're on inflation watch. Let's see if the data give them anything to watch today.
Mike, Fed officials did not blink. And a lot of people frame the situation they're in at the moment as facing upside risk to inflation and downside risk to growth. And they seem to be very keen over the past few days to really lean into the idea that they are going to anchor inflation expectations. That seemed to be the priority of Chairman Powell going into the weekend. When do you expect this inflation data to change, Mike, in the months to come off the back of some of the announcements we've seen from the White House over the past few weeks?
Well, we could start to see it this month in the April data if we see prices go up for goods coming in from China, because remember, he raised tariffs on China in February, so we could see an impact there. But it would probably take another couple months before the rest of the world gets to that point, because you don't know what people have in inventory, and you don't know what is on its way and when it would hit the ports. But probably by the June meeting, the Fed would have an idea of where they're going.
And there's a meeting between now and then. Mike McKee, appreciate it. May 7th is going to be an interesting one, Lisa, for this Federal Reserve. A Fed official you follow closely, the San Francisco Fed President Mary Daly, making the point that she believes the policy is in a good place.
Yeah, because they cut by 100 basis points. It still is, you know, less restrictive, but at the same time, it's restrictive enough to bring inflation down. There is dissonance for them, because on one hand, they're looking at companies that still have pretty healthy situations with consumers that are still spending, but they have to project forward at a time where that's unknowable. Erica Najarian was saying that, you know, if, you know, next year isn't 5 minutes from now, which might not be desired. Actually, I think it would be very desired for a lot of us. west, and it's sort of hard to see the path from here to there.
And we're in the midst of a trade war now between Beijing and Washington. Look at the headlines this morning. You have China coming out and saying, actually, we're going to ditch some of our U.S. soybeans and we're going to lean into Brazil. It's exactly what they did in 1.0. And guess what the U.S. government had to do? Trump's administration, in that time around, they had to go to Congress and ask for a bailout for our farmers. So if you're the Federal Reserve, how difficult are these decisions in the midst of really whipsawing policy and the escalation from trading partners?
Got some deals if you want to talk about it. Prada agrees to buy Versace. Enterprise value of $1.375 billion. Got a deal there. You happy with that one?
That's why I wore Prada today. I was expecting this deal to come through for Versace. No, I'm just kidding. I did not know that. Well, luxury, I guess, back in play. Remember, it was that former deal between the FTC wouldn't agree upon when it was the handbags, Jonathan?
Yes, entry-level luxury.
Yes, so this is full luxury. And I guess Prada's expanding.
This is super high-end luxury. Inflation data up next. Let's move on from that conversation. Torsten Slock of Apollo joins us in just a moment. David Kelly of JP Morgan Asset Management here to react. From New York, CPI up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Inflation data in America just seconds away. CPI just around a corner. Your scores going into it look like this. Equity futures on the S&P down by 1.9% on the S&P 500. Yesterday, the biggest one-day pop since 2008. This morning, declines resume on the Nasdaq, down by 2.3. In the bond market, bond yields, 2-year, 10-year, 30-year. Your bond market looks a little something like this. The 10-year Treasury at the moment, yields down by 4 basis points. Your yield, 4.29. Your data with Mike McKee. Good morning, Mike.
Good morning, John. Well, we come in much better than expected on headline CPI and a little bit better than expected on the core, up by 0.1%. The forecast was for 0.3, and that pushes us down to a 2.8% annual rate for core, which is going to be the lowest in some time. I'll have to get a statistic on that for you. Headline goes down by 0.1%, and that pushes the number to 2.4% on a year-over-year basis. We're getting very close to the area in which the Fed thinks we should be, what they're looking for. Jobless claims right on the screws. Forecast 223,000. We get 223,000. Continuing claims 1,850,000, and that is a bit of a decline from 1,893,000 revision to last week. So are we getting any kind of pop from this, John? I'll check the details here while you...
We're seeing some moves, Mike, but in the bond market. So yields down at the front end of the curve. We're down 9 or 10 basis points. Your 2-year at the moment back to 381. But the volatility we've seen at the front end of the curve has just been unreal. As we mentioned a few times on this program yesterday, a 38 basis point trading range intraday at the front end of the curve. This morning on 10s, we're down about 4. So off the back of that, you unlock some dollar weakness, euro strength. Euro dollar now highs at a session through 111, 111.22 at the moment on that currency pair. Equity is the smallest of bounces. At the moment, we're down about 1.4%. Mike, as you go through the details, when you get softer prints like this, just to frame things, typically we'd have a conversation about the Federal Reserve maybe getting some confidence to reduce interest rates even more. But Mike, this time around, I just get the feeling that for the Federal Reserve, they've just got to wait a whole lot longer to see how these policy changes of the past few weeks bleed into the data in the coming weeks and months.
Absolutely. This is backward looking, and it's also been eclipsed by the tariff news, which should push up inflation. So the Fed is going to look through this. It's good news. It shows that they were on track. Remember, they were telling us that we were going to get down to 2%. They'd leave rates where they were, and that would put pressure on inflation. So to the point of Trump putting on tariffs, they were making progress. Now the question is, what happens from there? And speaking of Donald Trump, here's something that's not necessarily going to be good news for the White House in these inflation reports. It was energy. Gasoline prices went down during March, and that held the headline number down to a 1/10 decline. But food prices went up by 0.5%. Food at home by 0.5%. So people are going to go to the grocery store and say, well, we're not seeing inflation relief here, and the president promised that. That's something they're going to have to deal with.
Mike McKee on the latest data. Mike, we'll come back to you in just a moment. Stay close. Torsten Slok of Apollo joins us around the table. Torsten, good morning, sir. It's good to see you.
Morning.
Can I ignore all that?
Well, this is a Goldilocks starting point for the Fed, at least. I mean, the dual mandate says inflation should be 2. We moved a little bit more in that direction, better than expected. And on jobless claims, we also had a labor market that still is reasonably strong. So from that perspective, this is absolutely good news for the Fed that we did not get yet any inflation surprise to the upside. But obviously, we still have tariffs in the pipeline. And what's left on the tariff front could still add as much as 1 percentage point to tariffs over the next, to inflation over the next 12 months. So in that sense, this is backward looking, as Mike is saying. The risks are, of course, that there's now more upside coming to inflation.
So this is the issue, and it's a sequencing issue, and I'd love to get your thoughts on it. So sentiment's collapsed, basically created over the past few months. What we've started to see with CPI is just a bit of softness. That's encouraging. How long before we see the weakness in the output data, before we then see the higher prices in months to come? What comes before the other?
Well, let's think about how companies might respond to this. So now you know tariffs are coming. For example, if you think about Amazon, of the sellers on Amazon, 71% they source their goods in China. So one very important aspect is that it will be visible for everyone that prices are going up on things that are imported, of course, from China. So the conclusion to your question is, how do you respond to that? Do you take your existing inventory and sell that at the old prices? Do you take your existing inventory and raise the price immediately? That profile will probably be individual for different companies, depending on the competitive situation, which sector they're in, how sensitive they are to tariffs. So we just don't know yet what the impact will be and how quickly this will feed through. But we do know that higher prices are coming as a result of goods coming from China becoming significantly more expensive. So even if companies decide to sell the existing inventory at the old price, we will over time see some upward pressure on goods inflation coming from this source.
Is there a risk that we ignore this data at our own peril? The idea that actually lower energy prices are giving more disposable income to consumers to potentially go out there and buy, and that, oh yeah, it's also an offset for a lot of potential producers in the U.S.?
Absolutely. Low energy prices is very, very helpful for the consumer. But the other thing, of course, is that the whole surrounding sentiment around what's been going on is that we literally went from the last few days from nuclear winter to now back to talking about stagflation. And stagflation has these risks, of course, that you have headwinds from consumer sentiment being weak, corporate sentiment being weak. If you look at the Fed surveys for CapEx planning, they are really beginning to turn south. So companies are beginning to pull back more, likely because of the uncertainty. And let's not forget, we still have a $5 trillion net wealth effect on consumers from the stock market going down. So if I add this whole list together of weaker corporate sentiment, weaker consumer sentiment, tariffs coming, and a negative wealth effect, and on top of that also retaliation from foreigners who might be doing things to us simply because of the trade war, that brings you a fairly long list of downside risks to the outlook overall.
Which raises this issue of how we even game out the idea of inflation. Why potentially are we not talking about deflation or disinflation? And I say this given the fact that we see Walmart, for example, saying that they are going to invest in price competitiveness. Basically, they're going to absorb all of the costs from tariffs. At what point could potentially the lack of demand be the main story more than inflation?
And that's why the key issue here is who is going to absorb the increase in tariffs? Who's going to absorb the price increase in goods that are coming here, in particular from China? Is it going to be consumers that will face higher prices, or is it going to be taken out of margins? Will the E in the PE ratio go down as a result of this, as companies such as Walmart, Costco, and of course Amazon begin to say, well, maybe we are going to absorb some of this? And that remains to be seen exactly. Maybe it's going to be split across corporates and across consumers. But the bottom line still is that someone has to foot the bill when tariffs are going up.
Wall Street Journal has this morning that the president privately acknowledged that his trade policies could potentially lead to or trigger a recession, but he said he wanted to make sure it didn't cause a depression. Where are you now in terms of potentially having a recession this year?
So, of course, the last few days, it was pretty clear that there would be a sudden stop in the economy where prices would go up significantly, literally on all trading partners and everything coming in. So that was a scenario where a recession was very likely, almost at 100% where we came from. Today, the recession probability is probably 50-50%, meaning we think that there is still a likelihood we will have a slowdown. But the risk is we just don't know what the response is going to be from consumers, corporates, how much will markets go down further. In particular, this wealth effect on its own. Think about how we normally talk about when the stock market is going down. We go back to the spreadsheets and say, what's the marginal propensity to consume? How do consumers react when the stock market goes down? Here on its own, the stock market down now 5 trillion so far. And of course, now it's rebounding and then coming a little bit back again. That's on its own a fairly significant hit to consumers and the wealth effect for the consumer outlook.
We still don't know what the policy will be in a few months' time, including the tax code. This came from the president just moments ago, a social media post saying, great news, the big beautiful bill is coming along really well. Republicans are working together nicely. The biggest tax cuts in U.S. history getting close.
Well, it's because yesterday they had to pull a vote to vote on the budget resolution from the Senate in the House because fiscal hawks are saying that Senate bill doesn't do enough for cuts. So what's happening this morning? Speaker Johnson, Leader Thune are having a press conference later this hour to outline a plan to get Trump's tax cuts through. The president sees this and he says, oh, look, they're working together now. This morning, they weren't working together last night.
Can they change the conversation? Moments ago, we just had CPI data. Let's bring Mike McKee back in for an update. Mike, you've had a second look. What stands out?
Well, a couple of things, John. We talked about grocery prices, and meat prices were up 1.1%. Chicken prices were up. Pork prices were up. So people will really be noticing it at the meat counters in their stores. More bad news for the president. He'd been bragging about the price of eggs coming down, but they rise by 5.9% on the month, which puts them up 60.4% for the year. Last month, it was 58%. So egg prices are going back up. Now, the China impact, perhaps. We saw furniture prices rise on the month, and that is something we get a lot of from China, up 0.6. Bedroom furniture up 2.7%. Apparel up 0.4 after a 0.6 rise the month before. Also something we do get a lot of from China. Toy prices went down, though. Maybe that's because Christmas and Hanukkah are behind us. Smartphone prices, surprisingly, go down by 1%. So maybe that's an inflation number that is coming, but is not there yet. The big well, let me do housing because everybody follows that. Owner's equivalent rent up 0.4. That's a rise of 0.1%. So I was going to say the big thing that people are going to be watching going forward is energy prices, which were down 6.3% for gasoline. If that continues, it takes some of the edge off the food prices, and it does help the administration's case a little bit. But all in all, this is sort of a mixed report. The things that we thought would go down, airfares were down 5.4%, did go down. Some of the things we got from China did go up, and that's something that could continue with the big tariffs that they now have.
Mike, thank you for the update. Mike McKee there, following inflation data about 10 minutes ago. David Kelly of JP Morgan Asset Management joins us now for more. David, welcome to the program. How encouraging is that data this morning?
I don't really think it changes the narrative much. I think, Mike McKee was pointing out that airfares are down 5.4%. Actually, lodging, hotels and motels and so forth, was down 4.3%. So I think what we're seeing is a lot of softness in the travel industry, which I think is going to get worse over the course of this year. It is the calm before the inflation storm. We're going to get some higher inflation out of the tariffs. I mean, remember, we left the 10% universal tariff in place. That's a lot higher than anything we've seen really for decades. So that's high. And then, of course, there's enormous tariff on China, which is going to clog supply chains and push up prices too. So I think we will get some inflation there. But what I actually see in the data, looking particularly at the travel numbers, is a sort of a deflationary tinge to the economy or slowdown tinge to the economy already. So, I'm glad that the market rallied yesterday, and I'm glad that we've got rid of the worst of the reciprocal tariffs apart from on China. But I think that we are far from out of the woods here. I think that these data do sort of still suggest that there is a slowdown coming in the economy.
So the slowdown is what worries you more than the inflation, David, if I'm hearing you correctly, at a time where CPI just came in, when you strip out energy and food at the lowest level, going back to 2021. Are you saying that that's really what markets ought to be focused on, both bond and stock?
Yes, because people talk about stagflation all the time, but really it's always inflation stag. You get the inflation first, and then you get the stagnation. And the problem is that with the labor supply falling away, with these impediments to trade, with cutbacks in government spending, government grants, and so forth, a lot of fiscal drag this year, I can see a lot of things that are going to slow the economy down. We'll get a temporary surge in inflation from this, but I think we're going to be left with a pretty stagnant economy afterwards. And the real question is, does that revolt in the House yesterday in terms of House members who are fiscal hawks, is that really something or not? Are we going to have a bigger deficit in fiscal stimulus next year or not? If we have fiscal stimulus, then I start worrying about inflation again. But in the absence of major fiscal stimulus, I think people need to worry about recession more than inflation here.
Are bonds still the best bet? U.S. Treasuries in that type of scenario, recession, comes very much back on the table.
Well, yes. I mean, I think that, first of all, I think, long-term interest rates at 4.3%, 4.2% on a 10-year Treasury, I think that's fine. And I think people need, I'd be level weight in fixed income. I realize that we may have a mild recession here, but, longer term, whatever recession we have, we'll pull out of it again. And these bond yields are reasonable for the long run. I don't expect inflation to hang around the long run because, we'll get these tariffs and then tariffs just don't work and eventually we'll pull back from them, and that'll actually have a deflationary impulse in the economy. So long term, I'm not that worried about inflation. I am worried that there won't be much dynamism about the economy overall.
David, appreciate the update. I know you're busy this morning, so thanks for making time for us. David Kelly there of JP Morgan Asset Management. If you are just joining us, downside surprise on CPI. Market just kind of looks through it. Equities still session lows. We're down by 2% on the S&P 500. There is a bit at the front end of the curve. You see yields falling back by 8 basis points at 383 on a 10-year. And in the FX market, that unlocks further dollar weakness. Euro dollar through 111. We're at 111.15. Torsten Slock of Apollo is still with us. Torsten, David Kelly, calm before the storm. Focus on a growth story more than inflation. Do you agree with some of that?
Well, I'm not so sure. I mean, the last few days, the Fed has made very clear that they will also be focusing on inflation. So the real big question for them here is, Do they want their legacy to be Arthur Burns, or do they want their legacy to be Paul Volcker? Because if they walk out the door and have allowed inflation to be a lot higher, then of course they will have a serious risk. So I do think that this becomes a very, very important debate inside the Fed in terms of what weight should they put on the dual mandate when one side of the dual mandate says the Fed should be cutting, namely growth, and the other side of the dual mandate, inflation, said they should be hiking.
It's difficult to read minds, but based on the communication of the past week or so, do you get the feeling the weight of history is on their shoulders?
Because I do see some finer nuances between what's being said, in particular compared also with Jay Powell last Friday. Very importantly, can they get away with just saying, oh, we're going to cut because long-term inflation expectations in markets are very well anchored, because survey expectations are going up quite significantly, both in the short term and in the long term. So it really becomes a matter of where do they put their weight when it comes to inflation? Is it on actual incoming inflation, or is it on some measures of inflation expectations which are well anchored?
But Torsten, you said it earlier, you have tariffs still in the pipeline. Can they do anything until they actually understand the rules of the road?
I think they do the same calculations, of course, that the street is doing in terms of the impact on inflation is between half and a full percentage point higher over the next 12 months. Then I do think that they come to the conclusion that the forecast is saying inflation is going up, and therefore it's going to be difficult for them to signal a lot of rate cuts. So that's why the market currently pricing 3 cuts. It does make sense that we have a modest amount of cuts, but not more than that, even if growth does start to slow down more meaningfully.
Do you have a sense of how close they were to intervening with the Treasury market yesterday?
I don't know the answer to that, but I do know that they bought $100 billion during COVID, of course, in March of 2020, every single day in the Treasury market. And I do guess that they were probably worried that they would have to take out some of the same tools if this were allowed to continue. So if both it was caused by Japanese sellers, if the sell-off in rates was caused by risk reduction in asset managers, and if it also was caused by the basis trade unwinding, that combination and the fact that we don't even know which of these things were most powerful just still created a significant amount of risk to financial stability if this were allowed to continue.
Do you think people are trying to drift away from dollar assets? Do you see that building over the past week?
I don't see that, because the dollar would have gone down a lot more in the last few days than it actually did. So there are some discussions around maybe China or others were selling in custody holdings and just kept the money in dollars and didn't sell it and took it back home. But nevertheless, the fact that the dollar index just moved relatively sideways, the yen did appreciate, suggesting that it's correct that there might have been some Japanese sellers. But broadly speaking, the DXY index on my Bloomberg screen was relatively flat for the last few days, suggesting that this was not a questioning about U.S. exceptionalism. I still think the U.S. is exceptional, still the most dynamic economy, still the biggest financial market. We still have, of course, a lot of investors that are looking here to come and invest, and that does make sense. We just have, at the moment, some turbulence, of course, that people are thinking about, that this is probably mainly viewed as a short-term quibble in markets.
I hope you're right. Torsten, well said. It's good to see you, as always. Torsten Slok there of Apollo. Equity futures at the moment down 2% on the S&P. The opening bell is about 43 minutes away with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to recap the most recent data, March headline and core CPI both rising less than expected. A softer print with markets weighing the whiplash from the White House. The data is a welcome signal for the Fed. The central bank so far has been saying that it's prepared to stay on hold as it awaits any inflationary impacts from tariffs. And we have a deal in the luxury retail space. Prada is buying Versace from fashion conglomerate Capri Holdings. Prada will pay $1.38 billion for the company. Capri said it will use the proceeds of the sale of the business for investments, debt reductions, and stock buyback. Now, ahead of President Trump's tariffs, Apple flew as many as 1.5 million iPhones to the U.S. from India after it ramped up production in the country. Reuters reporting that Apple chartered several flights to transport 600 tons of its flagship product. Analysts have cautioned that iPhone prices will surge if the tariffs on China remain in place. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Up next on the program, we'll set you up for the day ahead. Live from New York City, you're watching Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah. We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Downside surprise on CPI, this equity market not taking comfort from that. We're down by 2.2% on the S&P. We're down 2.8 on the NASDAQ. As we count you down to the opening bell, should we get you some movers? We can get those movers right now. Let's cross over to Danny Berger, I believe, for more. Hey, Danny. No, Danny. Let's get to your trading diary. At 1 p.m., the U.S. Treasury auctioning $22 billion in 30-year bonds. At 4 p.m., President Trump participating in a bill signing. On Friday, PPI and new Mitch sentiment, plus bank earnings kicking off with JP Morgan, Wells Fargo, and Morgan Stanley. On Monday, Goldman Sachs earnings. Tuesday, Bank of America and Citi reporting, plus United Airlines results after the closing bell. One thing that is happening right now, I'm pleased to say, Speaker Johnson and Leader Thune will be holding a news conference, a briefing, any second from now. Tyler Kendall joins us from Washington with more. Tyler, what are you looking for?
Yeah, hey, John. Well, this presser comes after last night the House delayed a crucial vote on passing the Senate's budget resolution. At issue here is that fiscal hawks in the House don't think that the Senate's plan has enough spending cuts. The Senate plan calls for about $4 billion worth of spending cuts. You'll recall the House had wanted that number to be up to $2 trillion. Now, there is reporting that the two leaders could be announcing here a deal for $1.5 trillion in spending cuts. We'll have to see, because that is still going to raise some pretty big questions when it comes to what that could potentially mean for some benefit programs like Medicaid that really started this disagreement between the two chambers to begin with. John, these two chambers do need to ultimately agree in order to kickstart actually crafting the budget reconciliation process, which President Trump is really banking on because it's tied to his tax cuts.
Tyler Kendall, thank you with the update from the White House. Tyler, thank you so much. Anne-Marie, are we getting closer to this deal? How long is this going to take?
Well, obviously, having Speaker Johnson and Leader Thune come together and talk about potentially how they can bring both their caucuses together, yes, we are getting closer, but this is going to be so challenging. Because say you have these fiscal hawks in the House that say, I'm not signing up for something until I see the Senate cut back on some of their spending. Well, then you're just going to have Republican senators saying, there's no way I'm touching anything close to Medicare. So you're going to have this dance back and forth for a while. Push is going to come to shove if they include the debt ceiling within the package, and they have no choice but to vote it. And also when Speaker Trump starts getting on the phone and pressuring these individuals to sign up to his plan.
The president says the biggest tax cuts ever. There's a big difference between extending tax cuts and delivering new ones.
These aren't tax cuts.
Are we going to get additional tax cuts?
Potentially. We'll get no tax on tips, maybe one other add-on, one other sweetener, but all this is an extension of current policy, which is why, I mean, Erica was talking about it earlier. This is all already baked in. There's nothing that exciting about this bill. I know it's one big, beautiful bill potentially for the president, but all it is an extension of current policy.
That would have implications for this big, beautiful bond market at the same time.
Very much so, because if you end up with a bigger fiscal deficit, then all of a sudden, how much does that become the main driver? I remember a long time ago, like 3 days ago, when people were actually talking about how the bond market cared more about the budget than they did tariffs. Well, that changed for a hot second. But now there's going to be also a focus on the fiscal sustainability, especially if there is Japanese selling, especially if there is potential aversion from international buyers. We've heard mixed things, but that, I think, will become very much to the fore.
3 days ago feels like an absolute lifetime ago. Just yesterday, the president backing down, authorizing a 90-day pause on tariffs and doubling down on China, 125% on China. That unleashed a major rally in the equity market, the biggest one-day move we've feels like. Where will we be 90 days from now? Will we have to have another pause for another 90 days? And what happens in between? This market is not paying attention to the economic data. A downside surprise on CPI, and we're taking very little comfort from it. Your S&P 500 is down by 2 full percentage points. Coming up tomorrow to continue the conversation, Cameron Dawson of New Edge Wealth will be catching up with us as bank earnings season kicks off. On Wall Street, we'll catch up with Gerard Cassidy of RBC. We'll speak to Sarah Hunt of Alpine Saxon Woods, and we'll catch up with Veronica Clark of Citi before we go into a much-earned weekend for you all. From New York City, enjoy the Masters at Augusta National. From New York, get some rest if you can. This was Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we could do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be around the world. So it's the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
After the biggest rally in stocks since 2008, we are back down on futures. 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Shanali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, investors aren't letting their guard down as President Trump hits pause on tariffs for everyone but China.
Inflation unexpectedly cooled in March, offering some relief to consumers before tariffs filter through the numbers.
And CarMax joins a growing list of companies indicating that trade uncertainty is certainly making long-term planning difficult. All of that and more coming up. Let's take a look at what stocks are moving this hour ahead of the bell. Tesla leading the Magnificent Seven lower this morning, but that's after a more than 20% jump yesterday.
Apple has shipped about 1.5 million iPhones from India to the U.S. in an effort to beat President Trump's tariffs, this according to Reuters.
And we're looking at guidance from companies. CarMax is out with earnings today. The firm is removing timeframes for long-term goals due to broader macro factors. Katie.
All of this stems from an unclear endgame for President Trump's tariff onslaught, which he partially paused yesterday. Let's take a listen to his rationale.
Well, I thought that people were jumping a little bit out of line. They were getting yippy, you know? They were getting a little bit yippy, a little bit afraid, unlike these champions, because we have a big job to do. No other president would have done what I did. No other president. I know the presidents. They wouldn't have done it.
Let's get the latest from Bloomberg's Tyler Kendall. She is at the White House. And Tyler, do we now understand clearly all the details of who will and who won't be tariffed with these reciprocal measures?
Yeah, hey, Matt, still some really big questions. And as Bloomberg Economic writes, these whipsaw movements do very little to bring down those record amount of uncertainty. As of now, the so-called reciprocal tariffs are paused, but we have to keep in mind that the 10% levy across the board is still in place. And of course, that 125% escalation against China. And then also Mexico and Canada didn't see any reprieve as part of this because they weren't a factor in that original reciprocal plan. Now, Treasury Secretary Scott Bessent says that this was the plan all along and that it shows that the U.S. is negotiating in good faith, but there are still some pretty big questions about what it actually takes to clinch a deal. Now, NEC Director Kevin Hassett, in an interview this morning, did give us a little bit more insight. He said that while more than 75 countries have reached out to the U.S., he said that the White House was approaching about 20 countries who have made deals or offers to this White House that he called sensible. And he said to watch out for the non-tariff barriers, but also watch out for what he called the quiet things, such as military matters that could be wrapped into these deals. So we're going to, of course, be watching that very closely. And Matt, just quickly, I'd also mention it's not just countries who are soon going to be negotiating, but also companies. President Trump yesterday was asked whether or not he would be interested in giving exemptions to some companies. He said that that could come down the line, but when asked what would be the determining factor for that, he said that he was going to trust his instincts.
Bloomberg's Tyler Kendall reporting from the White House. And of course, here in New York, we're watching inflation. Investors are keeping a close eye on CPI day. Inflation slowed more than expected in March. Let's break down the data with Bloomberg's Michael McKee in the last big report until inflation starts to hit the line.
Yeah, we didn't really see any impact of the tariffs in this report, maybe just a little bit, but we didn't see much movement in the stock market or the bond market afterwards either because people are looking through this. The Fed has said the labor market's in good shape, and claims gave us no reason to doubt that. Comes in at 223,000, not a big deal for overall jobless claims in the labor market. But it's the CPI that people were watching, and it did come in light, down 0.1% on the headline and up just 0.1% on the core, pushing both numbers down into the twos, well into the twos for the headline, which ordinarily would be celebrated as progress for the Fed, but with the tariffs, we don't know what's going to happen. So what happened with the tariffs? Well, what we were looking for was to see if there was any change in the goods to services ratio because the tariffs are not on services. And we didn't really see that during the month. The blue line there, services, white is the goods prices, and goods prices stayed down. They have flattened out, but we'll have to see next month if they start to go up again. Where did we see the big movements? Well, we didn't see some of the China stuff you'd expect. Smartphones were down in price by 1.1%. That's going to change a lot if we do continue these tariffs because of Apple. Furniture, though, comes from China, up 0.6 on the month. Apparel, up 0.4 on the month. But here's where, and this gets to what Katie was talking about, the inability of people to plan or the people who are reacting in advance. Airfares down 5.3%, hotels and lodging down 3.5% as people apparently put stuff on hold while they wait to see what the impacts are going to be. And I know, Matt, you're going to care about this. The administration's been making a big deal out of eggs. Food prices went up 0.4, food at home by 0.5%. Egg prices went up, and now on the year they are up by more than 60%. Last month it was 58%. So the president is not keeping his promise to bring down egg prices.
Yeah, I wonder where he gets that data. He always says he's brought down eggs like 59%, but they seem to be the same price at the store.
We need a real-time ticker for egg prices.
That's what
Mike
you need.
McKee, great breakdown, of course. And we were talking about it yesterday. It feels like any single data point that isn't real-time feels kind of stale because there's a lot of uncertainty in this market. Let's take a quick check on futures right now. The S&P 500 lower by about 2% pre-market, but that follows a rally of 9.5% yesterday, your best day since October 2008. That's after Trump came out with the announcement that he will initiate a 90-day pause on tariff implementation for certain countries. Let's talk about this all with Heyman Capital Management founder and CIO Kyle Bass joining us now. Kyle, it's great to have you with us. I know that last week on a competing network, you said that I think the tariffs are thoughtful. I think they will work. With that in mind, I would love to hear your thoughts on what you make of the tariff rollout and now this 90-day pause. Which adjectives would you use now?
I'd use the same adjectives. I mean, look, and you got 75 countries to reach out to us in 2 days, and they're all the countries that matter minus China on a trade perspective. So, you know, it takes 90 days to sit down with someone and iron out something that isn't simply a tariff number. There's tariffs, non-tariff barriers, there's currency, there's all kinds of inputs to this equation. And so giving a 90-day reprieve while they hammer out trade deals is a good idea.
Kyle, we have had a lot of big multinationals pulling their outlooks due to this uncertainty, and then small Main Street businesses writing in en masse and saying it's just impossible to do business in this economy. Who are these tariffs good for?
I mean, it's more important to reset the trade relationships between the United States and the rest of the world. And I believe President Trump thinks that bilateral trade negotiations end up being better for the world's largest consumer, which is the United States. And so if we can get to a place where trade is more fair, then I think we can get to a foundation where we can grow once again and grow from a much stronger foundation. These tariffs, these non-tariff barriers, the manipulation that's gone on against the United States for so long is no longer going to happen. And I think our trade relationship with China is the one that doesn't look to have any off-ramps at this moment in time. But I can tell you that once all of these agreements get hammered out, the U.S. is going to be in a much better place.
Well, Kyle, to that point, I know that you're focused on China. Do you see any chance of a de-escalation? I know that you said that there isn't a clear off-ramp right now, but do you see any chance that things could cool down, or do you think that this trade war, specifically between the U.S. and China, is just getting started here?
Yeah, I mean, it actually got started back when China ascended the WTO, and China's been at this trade war with the United States for its entire ascension, call it 23 years. And so the U.S. has just figured out what China's malign intentions are. And we all know, we've seen their militaristic belligerence in the Second Thomas Shoal in the Philippines. We've seen it surrounding Taiwan. We've listened to the rhetoric of Xi Jinping, and we are now in a place where we're going tit for tat on tariffs, where I think China's made a grave error here. As you know, we only export about 140 billion a year to China, and we import, call it 450 billion from them. And so I think that if we're doing tit for tat on tariffs, then China loses, because there is no functional equivalency in the amount of goods and services moving back and forth. So we'll see what happens here. But I think it looks like we're in a game of we can call it a Chinese standoff or we can call it a Mexican standoff. I don't see an off ramp here.
Kyle, to the extent that you see escalation of this trade war with China in particular, you're looking at two whales in the ocean going at it, and you do have investors getting increasingly concerned about a weakening here of Chinese currency in order to boost their exports. How many tools does China have really in order to fight the U.S. on this battle?
Yeah, I mean, you heard Treasury Secretary Bessent said they're playing a poker hand with a pair of twos. They've got a banking system that's 3.5 times more levered than ours, and they've only been at banking roughly for 20 years, like real banking. So they've got a system that's levered to real estate, and real estate in China is down 30 to 50%, depending upon where you are. So they've got an insolvent banking system. They've got runaway unemployment amongst your youth. They've got another 12 million kids graduating their universities this year. And so you've got youth unemployment, a banking system that's insolvent. You've got a real estate collapse. And so when you're asking me what tools China has, they've got a couple of places where they could really press us, right? One, believe it or not, we still have the majority of our active pharmaceutical ingredients for all antibiotics in the U.S. made in the city of Wuhan. Yeah, that's just it's a sad truth. And then on the finishing side of synthetic graphite, on rare earth minerals, if you remember back in our trade spat in 2019, Xi Jinping made a visit to where they do the rare earth metals finishings, and we haven't seen Xi since April 7th. So we'll see. We'll see what he does, but he can start withholding things like antibiotics and rare earth minerals. But this is something that our administration has thought through.
Well, Kyle, I wanted to talk to you as an investor now, too, because as Shonali mentioned, of course, China has been signaling that it'll gradually let the yuan weaken. And I'm curious how you're approaching that, whether you're seeing that as a trade and betting against the offshore yuan.
No, I think I'm not at the moment, but I would say that it is not under China's control. When you think about, go back to the Asian financial crisis of 1997 and 98. It wasn't Thailand's decision to let go. It was Thailand running out of reserves. And so when you look at China and the offshore yuan, in the end, China's got to spend dollars to support that relationship. And China needs a strong yuan. They buy 13 million barrels of crude every day, 8.5 Bs of gas every day, and they buy 40% of their food every day in dollars. So if for some reason they have to let that relationship go and the yuan weaken, as we saw it weaken 2 days ago to its weakest level ever, we'll see if that relationship holds. And my view is that when you look at the differentials in interest rates and you look at China's bond market, the one thing that can't be lying coming out of China is their bond market. Look at the Chinese 10-year; it's collapsed. So their economy is in a very different place than ours, and that relationship between the yuan and the dollar and the Hong Kong dollar and the dollar that's a tenuous relationship, and we'll see what happens.
Hey, Kyle, just quickly, what do you think the most they can allow the yuan to weaken is? I mean, where's the point where they have to step in and can't allow any more slippage?
Yeah, I mean, it's just begun. All you've seen is a move from roughly 620 to 740 over a period of time. So, typically, again, when countries run out of reserves, as you know, the currency flaps in the wind. So there's this concept of them, quote, controlling where it is, and then there's the uncontrollable moves. And what we saw in the Asian financial crisis, even with the largest player back then was South Korea, we saw some pretty notable currency moves. And I think that's coming. And, I don't know if it's coming in the next month or so, but I'll tell you the interest rate differentials, the business cycle differentials are going to dictate the movements in the currency. So we do expect the Chinese currency to weaken pretty materially against the dollar.
Kyle, you are sticking with us. Of course, that is Heyman Capital's Kyle Bass. We're going to take a quick check on futures here before we head to break because, of course, you are seeing a bit of shaking off the exuberance you saw just yesterday. The S&P 500 futures down almost 2% ahead of the market open, more so for the NASDAQ 100 and the Russell 2000. Stick with us. This is Bloomberg Open Interest.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
And we're back now with Heyman Capital CIO Kyle Bass. Kyle, I want to talk about the tariffs that are still in place. Of course, we got the news about the 90-day pause on certain countries yesterday, but you take a look at what still stands. You have 25% on steel, aluminum, autos, 25% on auto parts starting from May 3rd. And I want to bring this to your home state of Texas. I know that you're a Texas guy, and you think about Texas's economy. There's a lot of car dealerships, there's a lot of car companies, and of course a lot of energy there. I'm curious, what you think the impact on Texas might be.
Yeah, I mean, in the near term, the impact is going to be slightly negative, right? But when you think about the carve-outs, first of all, we import about 4.2 trillion a year as a country. Roughly 40% of those imports were already exempt from this new round of tariffs. You mentioned the 232 tariffs, right? Steel, aluminum, autos, auto parts, things like that. But I think it's important to understand that those 232 tariffs, Section 232 tariffs, were put on by Trump in his last administration. And if you remember, Biden ran on we're going to cancel the tariffs. In the end, what happens is when someone like China, a state actor, can act uneconomically or non-economically, and they can flood your market with steel or aluminum or synthetic graphite or anything like that. And why it's important is they can act for a longer period of time to put your businesses out of business. So they can take capacity utilization down enough to where they can literally turn our steel industry off, turn our aluminum industry off. So those tariffs are necessary, and those will live, and they will live into the future, and they may not be high enough. We must maintain domestic production of certain things from a national security perspective, and that's why those stand where they stand. For autos, it's just you see China building plants in Mexico and Canada, so basically to avoid the tariffs on their cars. And so our negotiations with Mexico and Canada are primarily on fentanyl, secondarily on Chinese transshipments, and we'll end up getting this right.
Kyle, even if you believe that the tariffs are ultimately necessary for the American economy, how much more pain do investors have to bear? Because you do still see the S&P 500 after yesterday's rally still down more than 7% this year. You saw the bond market whipsawing wildly just this week. How much more pain is there as this transition and this negotiation proceeds?
I think, so we need to separate a few things that you said. The bond market had a fit, in this sell-off, and it was largely due to, it wasn't a basis trade. It's the fixed floating swaps, and I know that gets in a world that a lot of people don't want to talk about, but it was very simply a regulatory trade that bond traders had on, expecting banks' abilities to buy treasuries to increase. And then the tariff mayhem showed up, and that had to unwind. I think that had a lot to do with the crazy move in the 10-year. So I think things are settling down. But, as far as stocks are concerned, you've heard the president, you've heard the Treasury Secretary say, we have to make some difficult choices. And we must reset our trade relationships for the rest of the world. We also must narrow our fiscal deficit in the United States. And both of those things might be slightly recessionary. And if that's true, we might have to go through a brief recession in order to rebuild our foundation. And you say, how much longer can investors hold? Look, the market's not up and to the right, every year of every decade. And I think that this is a necessary resetting so that we can grow again in the future and grow more thoughtfully.
Kyle, as an avowed free market capitalist, I care mostly about myself, right? So the 2017 Tax Cuts and Jobs Act, President Trump punched me in the gut with a massive tax raise, right? Because he takes out all of a sudden this state and local tax deduction cap that's been in place, or it puts in a cap, after we had a state and local tax deduction for 104 years. If I can get a discount now on my taxes because of DOGE cuts or because of revenue on tariffs, I'll be happy. And you have said you think that DOGE is going to cut $600 billion out of government costs and that we could raise $600 billion in revenue. Is that going to offset the tax increase that Trump handed me in 2017 somehow?
No, and look, let me begin by saying, Matt, I know you're out in things for yourself, and that's, I guess, what you care about. The good news is you and I and Wall Street are not setting trade policy for the world, because if all we did was open ourselves to unrestricted free trade, we'd all be speaking Chinese tomorrow. We need to be thinking about national security in the long run. On the tax side, there are going to be some tax breaks, but they are not going to be for the top of the scale. It's going to be focused more in the middle class. And as far as state and local deduction caps, I mean, it's interesting to see the migration in the United States. You live in a place that sounds like it has state and local taxes. One could say
we all pay property taxes, right? Don't you in Texas?
Yeah, we do. We pay property tax. But when you think about high tax, high cost jurisdictions that some might say are mismanaged, you see the migration in the U.S. moving from the Northeast and the West Coast to the South, to Florida, Tennessee, Texas, South Carolina. And that's where major businesses and people are moving. And so I think that tax arbitrage or movement is going to continue for the next, call it 10 years to come. And I think you're seeing people vote with their feet.
And I do want to defend Matt a little bit. I know you care about more than just yourself, but people care about their pockets.
In terms of the wealth of nations, right? Adam Smith, that's how capitalism works. Right. Every man for himself. That's how it's supposed to work.
Well, Kyle, with that in mind, I want to talk to you about you and your future, because Bloomberg reported in January that the Trump administration was considering you for a post at either the Treasury Department or the Defense Department. And I'm really curious, here we sit in April, are you joining the administration?
I mean, I'm going to go no comment there. It's not worth talking about unless there's actually a deal on the table, and there certainly is no deal on the table. My biggest regret in life is that I've never formally served our country, and if there's a place where I can serve it and it can work out in my life as well, then I'm always open. I've got open ears.
Well, definitely come back if and when you do have a deal. But I also have another question, Kyle, for you about you and your portfolio. When you look at this market, how do you play this? What are the trades that you would put on right now?
I think when the market's down 20, it's year to date, which was I guess a couple of days ago. I think it's an overreaction. But when I think about the coming GDP prints, you're going to see a recessionary impulse. You're going to see a slight inflationary uptick on a couple of goods that ended up in the tariff melee. But I believe the slight recession impulse that we're going to see over the next 6 months will actually bring the general price level down. I don't think you're going to see a big inflationary move or stagflationary move. So I think 6 months from now, the market's going to be in a much better place. And that's with the caveat of if China doesn't attack Taiwan, if things in Iran don't get much worse, and if things in Russia, Ukraine don't get much worse, I think things are going to look better in the next 6 months. If China invades Taiwan, I think all bets are off.
All right, Kyle, we got to leave it there. You've been very generous with your time this morning. Really appreciate it. That is Heyman Capital's Kyle Bass. Hope to speak to you again soon. But let's check on these futures ahead of the opening bell. You're seeing a little bit of a give back when it comes to the S&P 500, down about 1.6% at the moment. You can see that similar move is reflected when you take a look at big tech, when you take a look at small caps. But certainly, you guys, we saw quite a pop yesterday, if you can call it that.
Yeah, insane. I mean, the biggest since 2008.
2008.
Right, 9.5%. It was, I don't think, a huge surprise that Trump blinked in terms of tariffs, but it was definitely a massive rally. Still doesn't bring us to the 5,500 level, that Wall Street bear, Morgan Stanley's and Mike Wilson said was a floor.
Yeah, and it didn't reach the second floor, though. I think that's another silver lining. We never hit that 4,700 level that he was talking about breaching and causing much more damage.
Well, the day is young. Markets aren't even open yet, so who knows what will happen. But less than 4 minutes to go until the opening bell. We'll kick off the trading day with Morgan Stanley's Andrew Sliman. This is Bloomberg Open Interest.
Are you worried about your borders because of what's going on in Russia and Ukraine? Is that something you worry about in terms of the impact of Russia, Ukraine on your investment appetite for things like that?
I'm not worried about Russia invading Norway anytime soon. We are a member of NATO. We do border to Russia, but now, since Finland and Sweden joined NATO, we feel stronger than before.
So today, what would you say your biggest investment concerns are? You're running $1.7 trillion fund. For the average person to not manage that much money, what should they be worrying about, and what are you worrying about?
No, I think you've got two things. One, you have the known unknowns, right? So, and there at the top of my list would be two things. One is inflation, because I think there is an argument in a tight tight labor market when you potentially decline the supply or reduce the supply of labor. In the US, you put on tariffs. These things can be inflationary, and there could be a moment where, given the high level of government debt, that the investors suddenly decide, you know what, we want a much higher coupon to lend to, to governments. And so you could see a step up in interest rates, which could be negative for financial markets. Then, of course, all the AI-related stocks, the epicenter here is Taiwan, so you need to watch that. The thing that really scares us when it happens is the unexpected,
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are significantly down, although these numbers, in comparison with the face-ripping rally that was executed yesterday, look like nothing. 2% on S&P futures after the cash trade yesterday produced a gain of 9.5%. I'm pretty sure NASDAQ was up like 12% yesterday, and futures are only down 2.5%. That's a win if you do the math, at least now at the open. Breaking ground, ringing the opening bell at the New York Stock Exchange. I believe that's a charity to try and get homeless people some help and off the streets here in New York. And then you've got a Chinese education company pushing K through 12 education in China, ringing the bell on the NASDAQ. Ruan, Yun, I think they just went public. So, Katie, in terms of the real stocks to watch today, and in terms of the action after yesterday's indiscriminate buying, what are you seeing?
Well, we're seeing that there's still plenty of uncertainty out there. We had CarMax report earnings today highlighting that continued uncertainty. Even though we got a little bit of relief yesterday, the firm actually removing its timeframes for its long-term goals due to broader macro factors. You can see that the stock absolutely getting punished right now, down 12, now 13%, Shonali.
Yeah, I'm looking at Apple here as well, getting punished once again this morning, down more than 4.5% at the market open. They have shipped about 1.5 million phones from India to the United States in an effort to beat President Donald Trump's tariffs, according to a Reuters report.
And let's get a check on the overall Mag 7 index. I think it's BM7T index on the Bloomberg terminal. It is down right now about 3%. This is on the day. If you look on the year, we're still looking at double-digit losses even after yesterday's big gains. Let's get a closer look with Caroline Hyde. She is, of course, the co-host of Bloomberg Technology, and she joins us here on set. So, ripping face yesterday, and,
nice way of putting it.
And not really giving up so much today in terms of the mega cap tech stocks.
I mean, considering it was the best day for Apple since 1998, and you're only down 3%, a bit of profit taking is going to be totally unsurprising. Same too with Nvidia, off by about 3%, having soared since May 2023, but still up more than 20%. Tesla up more than 20% as well, having its best day since 2013. These stocks ramped hard, even though they remain exposed to China. And this is what everyone's trying to get their grips with. Morgan Stanley saying with Nvidia, look, the tariff chaos isn't over yet for Nvidia in terms of the overall macro pullback that you might see in terms of spending on AI more broadly. You've got Apple. You were just saying, Shonali, what a fascinating story coming out of Reuters more broadly. 600 tons of iPhones managing to be shipped, all the memes about all of the airplanes coming over and on airplane mode. But all of this is just, do you like that? But more broadly, this is a company that's going to have to navigate how much really can they send and sell us via India. They still have about, what, 90% of their iPhones made in China, according to Dan Ives. You've got Dan Dolev thinking that's maybe about 85%, but whatever you call it, bulk being assembled in China, they've got to re-navigate. They ain't bringing their manufacturing to US for the iPhone.
We make a great point. I mean, Matt, you said that there was indiscriminate selling. Now there was indiscriminate buying yesterday. Those companies, a lot of the tech companies that we saw rally, are exposed to China. I want to talk about what's going on in China's stock market, though, because I noticed some of their e-commerce ADRs were popping this morning. What is the outlook there now?
Well, the consumer may be a little bit more buoyant if they get the stimulus that the government is now trying to navigate. If you're going to put this much pressure on a macro economy, well, you're going to get a macro response coming from the government trying to give the stimulus, and therefore PDD is going to go a little bit higher. These companies that operate e-commerce like Alibaba, maybe they will get a little bit more support. And of course, the local domestic EV makers, many feeling that there's going to be a flock to BYD, to NIO, if you're going to be a push against Tesla, for example, from a political standpoint. So maybe some of those domestic names start to rally a little bit, and that's why you're seeing like the Golden Dragon Index, the NASDAQ Golden Dragon, which is some of the top performers, the internet names in China, traded here in the US in terms of ADRs. That's on the higher side, even though the NASDAQ is pulling back.
You know, it's interesting to make a case for Apple, for example, just yesterday, despite the China risk, that idea that Goldman dropped their recession call after the changes.
Didn't take much.
Didn't take much. I mean, you know, if you're less worried about a recession all of a sudden because of a pause in tariff escalation, fine. But speaking to that pause, how are companies now navigating that next set of 90-day uncertainties?
Well, Apple's got to be rethinking how they, of course, use India, use Vietnam, use some of the other countries that they particularly outsourced to. But what's so interesting in terms of the stockpiling that was done, how many more of these jumbo jets are we going to see full of iPhones? When you think of what's happened with TSMC, the numbers were stark overnight. They did phenomenally well. Their quarter, 42% increase in revenue for their preliminary numbers. This is the chip maker for Apple. This is the chip maker for NVIDIA. And they saw a real push forward in terms of buying and trying to onboard and get your inventory in check. That's likely to continue into the next 90 days. So their next quarter is looking really rather rosy. Interestingly, analysts are thinking, look, in the longer term, the AI spend, the commitment that you're still hearing from NVIDIA, from the likes of, well, Amazon, for example, in an investor letter, we're likely to still see the AI trade work.
Caroline, great having you here with us today. Thank you so much for joining us, and we'll tune in to your show at 11. Joining us now is Andrew Sliman, Senior Portfolio Manager at Morgan Stanley Investment Management. And I guess, you know, your head, like all of our heads, must have been spinning yesterday. Even if you expected President Trump to blink, that rally was unreal. What do you make of it?
Look, I think there's more certainty. I know this is controversial. I think there's more certainty around the ranges the market will trade at today than there was yesterday at this time. And that is that 15% declines, they happen, not they're not that infrequent. You can have 15% declines, but 20% declines is when credit markets tend to seize up. And we got close, but we weren't at 20% declines, and the president pivoted. And because of, as he said, because of credit markets. So I think that puts a downside cap, somewhere at 4,900 on the S&P. I'm not, as I've articulated all year, I think this is a pause year for stocks, but I don't think it's going to be a real negative year. And I think the president just told you he's not going to let it get too negative yesterday and too many shorts. What I saw, the good news going into yesterday is at the beginning of the year, there was a lot of optimism.
Right.
Kind of strategists were predicting 6,700 on the S&P by year end. And a lot of that optimism had been washed out since last week. That's, as the market dropped, that's actually healthy. There's more pessimism. You don't want when everyone's optimistic, and that's what I saw at the beginning of the year. So I think it sets up better, but I still think, this is a trading year. It's not going to be a great year for equities, but what I learned yesterday is you got a president who doesn't want it to be too bad either.
Yeah, I like that framing. It's not going to be a great year, but it's going to be a trading year, and that certainly sounds fun for some people. With that in mind, I want to ask whether you would buy a dip here. You see the S&P 500 down about 2% at the open. You had Citi's wealth head come out and say, don't try to catch this knife. Don't buy this dip. Where do you stand, though, if this is a trading year?
Sure. So I'm really excited because on Tuesday morning, before this all happened, we sent out a commentary to our investors saying the market is down 15%. And based on history, because I don't think anyone really knows unless you have access to the Oval Office, you don't know what's going to happen. When the market's down 15%, the playbook says you are supposed to step up and add to your equity allocation. And by the way, don't do all of it, because if it's down 20%, you should add more, and down 25% even more, because at the end of the day, the returns off minus 15% declines or greater 1 year out are better than the normal average return for equities. So the answer to your question is, I wouldn't be a buyer here, but if you miss that 15% first step, I think you might have a second chance. I think there's a good chance you'll have a second shot at it. I don't know if it's going to come in the next couple of weeks, but usually the playbook, Sonali, is the market rallies off the low, and then the VIX comes down, so the uncertainty recedes, but the market kind of bleeds back lower to a previous low. And if that's down below 15%, yeah, I think you'll have another chance. I just wouldn't chase it here after yesterday.
One question I have is how much you are watching the headlines. We were all sitting here yesterday morning when Donald Trump was tweeting about having to buy stocks, or saying that you should be buying this dip, right?
Posting on Truth Social.
Right. Truth Social.
That was a huge moment.
Do you listen to that? Do you watch him post on Truth Social and follow him as though he's the one that's giving the ultimate financial advice?
Well, I mean, just think back to the great financial crisis of 2008. It was a snowball that politicians couldn't reverse because of all the internet connections of derivatives. They couldn't stop it. So it ended up being a very, very bad for the economy and very bad for the stock market. This is very different. As we learned yesterday, one politician can change everything. And that's what we learned yesterday. So yes, you have to have, you have to know what's going on, because this is the markets are being driven by what's coming from, the White House. So I think it is very, very important. And that's why it's my belief that we learned yesterday that 4,900 is probably a low level that won't be breached, because that's when markets tend to seize up down 20%, and we learn that the president doesn't want that.
Andrew, great to get some time with you today. Thanks so much for joining us. Morgan Stanley's Andrew Sliman, I guess, holding our hands through these volatile market times. Some more stocks, some more movers on our radar today. Prada agreed to buy Versace for $1.3 billion. Constellation Brands issued downbeat guidance due to tariffs and muted demand. And then tomorrow we get bank earnings. I got to pay special attention to all this stuff because I'm playing against Sonali a little later in the pointed quiz.
My poker hand has a flush in it.
Nice. I think you're going to win this. We're doing this pointed thing. You know what pointed is?
Yeah,
it's
I love
like
pointed.
A quiz on Bloomberg.com.
It's a new Bloomberg.com quiz. It involves leverage. It's super Bloomberg, but it's super fun.
All right, so we'll be doing that later on. And coming up, U.S. President Donald Trump says U.S. Steel should remain an American company, pushing back on its potential $14 billion sale to Japan's Nippon Steel. We'll have the latest with Joe Doe. This is Open Interest.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Comcast getting downgraded to a sell over at BNP Paribas Exane. The firm citing earnings risks in areas such as advertising and media. Next up, we have Carnival actually getting upgraded over at Morgan Stanley. The analyst says that most of the bad news is already priced into cruise stocks, but you can see currently down about 8%. And finally, we have Ford getting cut over at Goldman Sachs. Ford is especially vulnerable to Canada's 25% retaliatory tariffs, since the majority of the cars that it sells in the country are manufactured in the U.S., Shanali.
And let's turn to another stock that we are watching, U.S. Steel, because President Trump says the steel maker should not be owned by a Japanese company, suggesting that he does not support Nippon Steel's $14 billion bid for the steel maker. Bloomberg's metals reporter, Joe Doe, joins us at the desk. You're seeing a big drop-off, and the reason you're seeing a big drop-off is because you saw a big boost the other day when he called for a review of the previous CFIUS review, didn't he? It's confusing, the messaging.
I mean, you really cannot make this stuff up. I haven't seen anything like this. We've followed this since August of 2023, and it's been a wild story since then. Monday, when the president came out and did the order to re-review the CFIUS review, a day later, Ancora, the activist investor, says they're actually withdrawing their activist, trying to nominate the board and put in a new CEO. And it felt like, kind of for the first time, like since March of 2024, that this deal might actually have a chance. And you were talking to the people invested in the stock, and they're like, well, this is pretty good. And then after a great day in the markets, right, you know, the stock jumped up to $46 along with everything else. That's the highest we'd seen since March 2024. The president comes out in the Oval Office, and amid talking about steel generally, says this about U.S. Steel. And the stock immediately dropped off after hours by 16%. And I started getting calls and texts just saying, what the F? Right? I mean, this is really hard for investors to understand. The president has said, listen, I don't want U.S. Steel to be owned by a Japanese company or any other foreign company. He's made that clear. But the fact that in the background we had reporting that Lutnick was meeting with Nippon Steel and the activist investor, it felt very much like a Trump, let's get the deal done type of thing. But obviously he came out yesterday and said what was on his mind.
Well, I mean, I think it's pretty fair to say that on both sides of the aisle, steel is considered of national security interest, right? We have to have our own steel makers, but we do have others, right? We have Nucor, we have Cleveland Cliffs, we have Bethlehem Steel. So do we need to have U.S. steel? Is that important for national security just because the letters U and S happen to be at the front of the name?
Listen, you don't want like a company to just go bust, right? And to be clear, U.S. Steel will not go bust if this deal doesn't happen. Like, this is not a company that, by the time the deal started to happen, it wasn't like U.S. Steel was where it was in 2015, there were serious questions about whether or not this company could survive. The company since then bought a bunch of mini mills down in Arkansas. They doubled the capacity down there. Investors liked that narrative. That narrative is what attracted so much interest in the market to buy the company. Listen, U.S. Steel is here. It is here to stay. The question is, how is it here to stay? Does Nippon Steel ultimately get this deal? I don't know. There's a 45-day review by CFIUS that's going to happen. The president then will make a decision. It's just that yesterday, the president came out for the first time in what felt like nearly 2 months and gave his latest opinion, which was Japan should not have a majority stake in this company. I don't know what to tell you guys other than it could change tomorrow or the next day, or he may actually just kill the deal. We just have to wait and see.
Well, we'll have you back when he does. I'm sure we'll see you again soon. Good luck covering the ins and outs here. That is Bloomberg's Joe Doe. Now coming up, investors hitting the brakes on CarMax after the company missed fourth quarter estimates and pulled its financial targets. We'll take a closer look next. This is Bloomberg Open Interest.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Open Interest. Let's get a check on stocks right now. We're seeing down moves after the absolute hysteria that accompanied buying yesterday. The S&P was up 9.5%. The NASDAQ was up 12% and change. So these moves down, normally, 2.25% off on the benchmark index would be a real problem, but they don't look so bad compared to what we saw yesterday, holding at 53.35. In terms of absolute levels, that's not great. Let me look quickly here at yields, because this is important to watch. We're going to talk to Richard Farley about leveraged loans and the credit markets. A lot of people talking about a potential train wreck there, but it looks like that's been averted as well. In terms of individual stocks, you can see we have moves down across the board here of the big heavyweights, NVIDIA and Apple, Ford and General Motors off, as well as Stellantis and Tesla. A lot of car stocks there because we want to highlight CarMax right now. That stock sputtering after pulling the timeline of its financial goals due to macro uncertainty. It also reported worse than expected fourth quarter results. Bloomberg's Craig Trudell joins us now, our global car czar. And Craig, I figured CarMax has an ace up its sleeve because prices are rising quickly, both in the new car market and the used car market. Do they not profit well from that?
I think that may be a big part of why we're seeing the reaction here, because you would and you have seen analysts come out and say, look, this could be a company that's essentially a refuge from all of this chaos when the new car market is going to have this big disruption, this big inflationary event. It's going to lead to a lot of consumers being priced out of the new car market. They're going to go to the used car market. And here's a company that's sitting on, an awful lot of vehicles that just got a heck of a lot more valuable. I think, of course, there's more to the story than that. It needs to go out and acquire more inventory for the used cars it needs to sell, and the wholesale market is going to be sort of turned on its head by all of the chaos that we've seen out of the Trump administration. So it's not necessarily as clean a story as it might seem to be, sort of on the surface.
Craig, what are the cross currents here? It's a great distinction to make between the used car market and the new car market. But ultimately, when you think about the state the consumer is in and potential pains, we're going to see it in the next couple of weeks from some of the big lenders here. Can consumers afford new or used cars with leverage in this coming environment?
That's a great question. I mean, just yesterday I saw a headline out of Edmunds, which is a car market researcher, where they noted that in the first quarter we saw a record share of new vehicle loans taken out that were 84 months or longer, and that is just sort of incredible. That I believe it was more than 20% of new vehicle loans taken out in the quarter were of that length of term, and so. The consumer is absolutely stretched. We're seeing that in a lot of places, but in the car market in particular, especially since, to your question, the car market has never been, sort of more unaffordable to the consumer than it has been the last few years.
Craig Trudell, our global car czar out of London, thanks very much for joining us. By the way, fantastic story by Gabby Coppola on the Bloomberg terminal about Audi's best-selling car. In the U.S., it's the Q5, right? A kind of compact SUV. But since it's put together in Mexico and they're not USMCA compliant, they're going to be a total of 52% tariffs on that vehicle.
That is quite the sticker shock.
That's unsellable.
So buying the tiny cars are not going to get you away from buying a more expensive car per se. Guys, can we check on these markets quickly? Because you were seeing almost every sector in the red today. Yes. A lot of negative feelings out there after that big rally we saw yesterday.
Indeed, you can see the S&P 500 down 2.5%, but still, that's not doing much to erase that 9.5% gain yesterday, though. As Shanali pointed out yesterday, we are still in the red for the year, Matt Miller.
Yeah, coming up in the next hour, Richard Farley joins us on credit markets. Did they almost seize up? Mandy Sue joins us on the options market. Plus, AOL co-founder Steve Case talks to us about venture capital. This is Open Interest.
another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land, not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. The Dow dropped 800 points at the open, giving back some of yesterday's historic turnaround after President Trump paused trade tariffs for 9 months. The EU has responded, delaying taxes on American products. But David Wessel at the Brookings Institute says many are still worried.
Uncertainty about what the future holds is particularly high now, and that's a recipe for, frankly, for a recession, which is not certain, but certainly likely possible.
CBS's Weijia Jiang says tariff concerns continue to be top of mind for American farmers.
Will Hutchinson, a 4th-generation Tennessee farmer, says he is very concerned.
This is going to have an immediate and drastic impact to our ability to compete on the global marketplace for our goods that we produce here in this country.
The inflation rate dropped to 2.4% in March. That's down 2.8% year over year from the month before. But business analyst Jill Schlesinger says the numbers don't tell the whole story.
Overall, this report was better than expected, but it feels dated in light of all of the tariff news that we've seen over the last week. What we do know is that prior to the announcement of tariffs, inflation was trending lower.
House Speaker Mike Johnson's a happy man this morning.
I'm happy to tell you that this morning I believe we had the votes to finally adopt the budget resolution so we can move forward on President Trump's very important agenda for the American people.
He scrapped a vote last night over about a dozen conservatives from his own party who opposed the plan's lack of budget cuts and massive tax cuts. The bill would fund Mr. Trump's plans for the border, defense, and energy, but it would raise the debt limit. A mega deal in the world of haute couture. CBS's Vicki Barker at the foreign desk.
It's Versace. Just weeks after Donatella Versace stepped down from the fashion house founded by her late brother Gianni, another era is ending for the label. Luxury Italian brand Prada has just announced it's buying Versace from U.S.-led Capri Holdings for close to $1.4 billion.
Uber's released a new lost and found list. Most common items riders forget to take with them: phones, wallets, and keys. The other stuff, from CBS's Michael Wallace.
The list of unique items included Ozempic, Shrek ears.
Oh, for the love of Pete.
Divorce papers. A Viking drinking horn, 10 live lobsters, and a Ghostbusters ghost trap.
The Dow is now down 900 points. That's over 2%. S&P and NASDAQ each down about 3%. This is CBS News. Some pardoned Capitol attackers want their money back, the money they paid for repairs to the building.
A Justice Department court filing is before a federal judge who's considering a former defendant's request to be repaid the $500 in restitution he sent after a misdemeanor conviction. USA Today reports an assistant U.S. attorney says there should be reimbursement because Tracy Hager was actively appealing his conviction when President Trump issued the pardons for more than 1,500 people. Others convicted of more serious charges paid $2,000 in restitution. Steve Kathan, CBS News.
President Trump's forging ahead with his quest to make America's showers great again. He signed an executive order lifting restrictions on how much water can be used in shower heads. The president's blamed newer, more efficient models for ruining what he characterizes as his perfect hair. He says they force him to stand in the shower for 15 minutes till it gets wet. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive.
Nice job. You did it. You did it. You got it.
That right.
Yesterday was Friday, by the way.
Yeah, yesterday was Friday. So good Thursday morning from the Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. We got markets selling off today. Got the S&P off about 2.6%. We'll break all that down coming up. Sean Donnan, Bloomberg News senior economics writer. He's going to give us the latest on the tariff news. It changes by the minute, so we need to check in often with Sean and his team there. Dana Dioria, co-chief investment officer at InvestNest, is going to join us here to discuss her outlook for the markets. Michael McKee, Bloomberg International Economics and Policy correspondent, on the economic data we got today. CPI came in pretty tame, I think, across the board, so we'll break all that down. Kevin Whitelaw, Brussels bureau chief, on what the EU is thinking about tariffs here as it thinks about the United States. So we're going to break all that down in the next hour. Right now, let's go to John Tucker and get a Bloomberg Business Flash.
All right, for some perspective, the S&P 500 paring back more than a quarter of yesterday's surge. Investors still bracing for a protracted period of global trade hostility. Remember, tariffs still at 10%. The Chinese tariffs 125%. And most of the guests we talked to this morning say 90 days is not long enough period to try and come to some sort of agreement. The S&P 500, 154 points lower. That is down 2.9%, 5302 on the index. The Dow Jones Industrial Average down 950 points. That's down 9.4%. NASDAQ 100, 673 points lower, down 3.5%. The Russell 2000, 3.7% lower. That is down 71 points right now. NVIDIA, Tesla, Apple, among the Mag 7 stocks, leading the index is lower. NVIDIA down 5.8%. Tesla down 6.8%. Apple right now is 3.4% lower. Data today, consumer price index dropping for the first time in nearly 5 years. But Bloomberg economist Anna Wong sees evidence consumers are backing off discretionary purchases. Remember, it is the consumer that drives this economy. CarMax backing away from the timing of its financial goals. And here you go. Egg prices for consumers hitting a fresh record, rising 5.6%. $6.
Egg prices were coming down.
Well, this is for March from the numbers that we got. $6.22 a dozen, so that doubled from last year. Not excellent. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. So the two of you are gone tomorrow.
We are. Yeah. Not together, separately, but we are both gone. So
I didn't want to start any rumors.
John Tucker is going to be that host. Can I just go to the egg thing again? Because if you look at the egg index, large egg prices delivered to warehouses on a national level, they are down.
Okay.
Quite a bit. I'm just saying.
Well, like I said, that was the March figures that we just got this morning. Still pretty significant.
Yep.
I mean, if you can get them.
Yeah. Do you already miss us? Is this what's happening?
Yeah.
He already misses us. All right. Happy Thursday. Happy Friday to me and Paul. This is Bloomberg Intelligence Radio. We bring you all the TED news in business, economics, and finance. Let's scroll down to some of the stocks on the move today. And for that, we go to Isabel Lee, Bloomberg Cross, asset reporter. What are you looking at?
Carnival. It's edging lower by now actually more than 9%. Carnival upgraded. So Morgan Stanley upgraded Carnival, to equal weight from underweight. So the analyst said that a lot of bad news seems to be priced into the cruise stocks given share price decline. So basically, its risk-reward looks fairer now. But why is the stock plunging on this? They did reduce their price target to $21 from the previous $25. And cruise stocks in general have really seen a huge drop this year from year-to-date highs, averaging around 41%. But I feel like, and analysts say this, you would want to steer clear of the cruise sector when there's a recession or an imminent recession, because who would be taking cruises?
Well, I think cruise people are pretty passionate people. I mean, it's almost like a utility to them. I don't know, but you're right. That's a discretionary spend.
I've never been to a cruise.
You've never,
No,
me neither.
No one here has, so we can't really say.
No, Charlie Pellet.
But it's not just that.
I
It's
have
also
a kayak.
things like
Does that count?
Kayak.
No. But thanks for asking. Also, you got apparel and furnishings also falling in the CPI. So if you put them all together, maybe you're seeing a little bit of broader weakness there. What else are you looking at?
CarMax, this is a big drop because it's down by almost 17%. So they backed away from the timing of their financial goals. They really just joined a long list of companies doing that. Delta is the recent example. They pulled their 2025 profit guidance. So CarMax is a used car retailer. They did make progress towards their target. They said they will, but they didn't give any timeline. Trump's tariffs are expected to hit the auto sector, in particular, with a 25% levy of imports. We have car buyers rushing to dealer lots last month. So really, we're going to see if it drops even more today, but it's really suffering steep downturns.
I bought my car a few weeks ago. I wasn't thinking about the tariffs, but maybe
Good timing.
maybe that was good timing.
He sounds like he bought the car for himself. Let's just be clear. This was an offspring purchase.
Yes, for an offspring. And we leased it for the offspring.
But this was a very good lease at the end of the day. And also just goes to show in a tough tape, right? That story about Delta not having guidance, very different than like a CarMax, etc. What else?
Lastly, Constellation. So all stocks in the red. This is also in the red, down 4%. So they're a beer, wine, and spirits maker. They issued downbeat guidance, weighed by new tariffs and really muted demand. So the company expects earnings to be lower than estimates for 2026 fiscal year. But this already factors in the tariffs, because we've also heard a lot of companies not factoring in tariffs. We have Truist Securities saying they were surprised the company offered guidance at all. Even before this, Constellation has been struggling with lackluster sales, because we all know that alcohol demand has really been sinking. And even with this tariff, that's going to be... It has.
Not in my house.
Let's be honest here.
What are you talking about?
But there have been so many different Surgeon General warnings now about like how many drinks you can drink a week and still be healthy. There was kind of a reset after COVID when everyone was drinking like they had wooden legs. Only talking about me, but that's okay. Anyway, but it was interesting to see Constellation Brands with that and really pivoting to the higher end wine and spirits from that. All right, thanks so much, Isabel Lee, a Bloomberg cross-asset reporter. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. All right, let's get to the main story of the day. And as, of course, global trade. Want to get more on this with Sean Don and Bloomberg News, a senior economics writer. So we've had a wild 24 hours. How would you describe the trade situation today?
Look, I think what's fascinating today is that we have had markets go up and then start to come down again as they realize that we still have in the United States the highest tariffs that we have had in a century, and they remain in place, and they're still doing damage to the U.S. and the global economy based on what we're starting to see in terms of shipping bookings, in terms of companies talking about canceling orders, putting hitting the pause button on all sorts of decisions. So the tariffs as a kind of economic event haven't gone away, even though President Trump kind of scaled back some of his plans yesterday.
Sean, when you listen to some of the Trump administration, they seemingly their number one talking point is the number of countries that have reached out to the U.S. to talk about trade, talk about tariffs. I think the most recent number I saw was 70, and it seems like the higher the number, the better from their perspective. How is this all going to work here? I mean, is every country going to send a delegation? Are they going to send a term sheet over the fax? What are they? How does this happen?
Yeah, look, I think we've already been hearing some stories of countries sending term sheets, or the Trump administration asking for countries to pull together term sheets. We know that delegations were coming over even before the Liberation Day on April 2nd. So there's been talks going on. People have been trying to sketch out the outlines of a deal. But one of the key points we're also hearing out of the Trump administration is that countries probably aren't going to get a break below this 10% baseline tariff. And there's also these sectoral tariffs that have gone into place, like that 25% tariff on imported cars. That's not going away. And that really affects the European Union. It affects BMW. We've got a fantastic story on the terminal today by Gabby Coppola from the Autos team on the Audi Q5 SUV, which is made in Mexico, and basically is made as a kind of global product, and the tariffs that are going to hit it are actually mount up to something like 50% of its price here in the United States. And then the smaller Q3 is made in Hungary. Likewise, you know, it's going to be hit hard by all of these tariffs. So, you know, a lot of countries are trying to figure out right now what they can get from Donald Trump. And if the answer is you're not going to get much below a 10% baseline tariff and these sectoral tariffs, remember there's also pharmaceutical tariffs, there's lumber, there's copper, there's all sorts of other sectors that are going to be hit by other sectoral tariffs that are coming up, then really what are we going to offer in return? And then you have, you know, the biggest kind of economic giant outside of the U.S. there as well, which is China. And what we've seen break out there is all-out trade war. I mean, essentially, we've got now on the U.S. side 125% tariffs, on the Chinese side 84% tariffs. Talk to most business people or economists, they will tell you that those are prohibitive tariffs. Those are tariffs that mean that you kind of shut down all trade other than in essential goods, and those essential components that you need to kind of keep production lines running in the United States, or that you can't get from anywhere else, are just going to go way up in price, and that's going to have its own economic effect.
Okay, so then we have that baseline 10%. We still have a very hefty trade war with China. What about EU and Canada? So if the baseline 10% is still there, the sectoral tariffs are still there, where are the other added tariffs? They're not really negotiating.
Well, they're starting to, like we heard from the European Union today, that, you know, they're starting to work out what they can do, and that they're pausing their retaliation. But if you remember, under the announcement April 2nd, they were facing a 20% tariff. So coming down to a 10% tariff is on, you know, this broad tariff is good. But then you have all these other questions around cars, for example, as I was mentioning, and pharmaceuticals, which is a huge issue for the European Union. In fact, U.S. companies make a lot the inputs for pharmaceuticals that we buy here in the United States in Ireland, and that's a huge source of the trade deficit. With the European Union.
All right, Sean, thank you so much. We appreciate it. Sean Donnan, he's senior economics writer for Bloomberg News, joining us from Washington, D.C. Via that Zoom thing here. And again, I'm just looking at that article about building the Audi's top-selling SUV. They're getting tariffs totaling maybe 52%, basically saying that makes this car unsellable in the United States. What does a company like Audi, which is part of Volkswagen, do? Interesting times. This is
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg newsroom with this Bloomberg Business Flash being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more at your timetable. Learn more at ipkr.com/round-the-clock. Right now, we're giving up some of yesterday's gains. S&P 500 down 2.8%, down 151 points right now. 5306 on the index. The Dow Jones Industrial Average down 905 points. That's down 2.25%. The Nasdaq 100 down 616 points. That's a decline of 3.2%. Right now, Tesla and NVIDIA leading losses in a magnificent 7 stocks as the group pauses after yesterday's surge. NVIDIA down close to 5%. Tesla shares down 6.3%. And then you have Apple down 3.5%. In the S&P 500, CarMax is actually the worst performing stock. It's down over 17%. They removed timelines for their financial goals due to uncertainty about the trade war and the broader macro factors, as they put it. U.S. Steel shares, they are dropping right now. U.S. Steel down 8.2%. President Trump said he loves Japan, but he didn't want a Japanese company, Nippon Steel, to name it, to buy the steel manufacturer. And then, again, that deal news today in the luxury space. Prada buying Versace, $1.38 billion in cash, buying Versace from Capri. Remember, they paid $2 billion for it. This has been ongoing for months. The purchase, the largest in Prada's 112-year history, returning Versace to Italian ownership. I'm going to say Prada projects a more subtle aesthetic than Versace.
Really? That's where you're going?
That's the line in the story. I don't know what the hell I'm talking about.
I mean,
I'm just
I
parroting
think it depends, because Prada prided itself on, like, being weird. Now, weird, different than Versace weird, but still.
Is, like, flashy.
Flashy, yeah. Prada's not flashy, but
like
maybe
me.
like architectural weird. Yes, when I think Versace, I 100% think John Tucker, yeah?
Yeah, sure.
For
yeah.
sure,
Okay.
yeah.
Okay.
When I think Prada, I think Michael McKee.
All I know is they sold it for a lot less than they bought it for. So anyway.
I have no idea what I'm with John on this one. This is a little bit like Matt Miller talking about his Lamborghinis and Ferraris. And
naturally aspirated.
Yeah, but luckily you guys have me, and that's the good thing there. All right, John Tucker, thank you so very much.
Anytime we talk about sports, you could throw out
Versace?
Versace,
yeah. We like John Tucker there with the scarf wrapped around his neck. Okay, this is Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. You can also check us out on YouTube. Just go to youtube.com/Bloomberg Live and check us out there. So as I mentioned, Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now. So, Mike, it was interesting with the CPI. Bloomberg Economics had the note out that said this wasn't about falling prices necessarily, but it was more about falling demand in travel, leisure, in apparel, in furniture sales, and stuff like that. Walk me through the details.
Well, the biggest drop was in gasoline prices, which is sort of a combination of anticipated falling demand by the gasoline producers, refiners, et cetera, given the impending tariffs. And then we also saw some declines, as you mentioned, in travel prices, and that was definitely tariff-related. But the rest of it was sort of mixed news. Food prices were up by, food at home, grocery store prices were up by 0.5%, a fairly large gain. Then 2 months in a row where food prices are up. And we saw apparel prices rise, but is that just a natural move, or was that also an anticipation of tariffs? Furniture prices, we get a lot of furniture from China, those were also up. So the report is kind of a mixed news thing, except that the overall good news is it went down. And if you were not going to have tariffs, if none of this had happened, it would be exactly what the Fed would love to see.
Right.
So when do we expect to see any inflation impact in these CPI numbers and the other PC deflator? When do we expect, if there's going to be any inflation impact, when do we expect to see that?
It's a little hard to say. Probably, maybe, could be. Hedge it enough here. Next month, this month's data, when it comes out next month, because it could reflect tariffs that the president has already put on. But it's probably going to take a couple of months. Maybe we get something in the May numbers. First of all, companies have to figure out whether their products are tariffed or not. That seems to be bouncing around. And then it's a question of how much stuff people have in inventory they can sell that they bought at the lower prices, how soon inventory actually docks at a port and the tariffs are applied. So it's kind of hard to say exactly when we're going to see this, but it would be coming. And given the fact that we still have 10% tariffs on everybody, and now these huge tariffs on China, you will see it.
When is the biggest, what are you looking at next in terms of the biggest indicator? Is it going to be inflation expectations? Like, is that going to be the thing that's going to sort of give us that kind of insight?
Yeah, because that's tomorrow, so I'm pitching ahead to all the appearances I will do with you guys tomorrow.
Well, John Tucker's in charge tomorrow, so he will gladly have you on the show.
But University of Michigan tomorrow, the Fed has sort of downplayed the long-term inflation expectations number, suggesting that it doesn't quite reflect reality in the history of the Michigan numbers, but they do worry about the short term, and that has gone up significantly. And they have said, and Jay Powell said, that we are obligated to keep prices down, and we are very worried about the short-term inflation expectations should they become unanchored. So that'll be somewhat big news tomorrow. But I think we're redefining what big news in economic data means here, because once we get to the point that you asked about, when does this hit? Once we get to that point, then markets are going to react to every little data bit. But anything that is up to this point, people are going to say old news.
PPI tomorrow. How do we interpret PPI versus CPI?
Well, PPI is the easy difference to know is that CPI is what you pay to buy things, and PPI is what companies charge to sell things. And we may see some of the China impact in the PPI because we saw those big inventory builds in terms of industrial supplies and things like that in the past couple of months. And so if you were a Chinese company or from anywhere else in the world selling to the United States and there was this rapid rise in demand, you might raise prices. So we could look for some of that tomorrow. But so far, producer prices have been much better behaved than consumer prices. So overall, it hopefully is a continuation of the good news that no longer matters.
Can you clear something up for me? This is the stupid question for me from the peanut gallery. The guy picking up stuff at the port, that's the person who's going to pay for the tariff. It's not the exporter off in whatever
it's
China.
It's not the exporter.
It's the guy in Port Elizabeth, Newark, New Jersey.
This is the silly thing that the administration keeps pushing. That what they're talking about is that not that the exporter is going to pay anything, but that currencies, the dollars should rise, and that makes their currency cheaper, and so they.
Right.
You know, there's an impact on them in that case, and sure, but it's the company that bought the stuff.
Yep.
So this is the whole story from yesterday. There was like a back channel what thing that he wanted to buy. Some guy at Bloom's. Anyway,
No,
gotta go back and listen to that.
Yeah. Don't even go into that.
It's a whole different thing. Mike, thanks a lot. Mike McKee, Bloomberg National Economics and Policy Correspondent, joining us now. All right, let's get to Dana Diorio, Co-Chief Investment Officer at Envestnet, joining us from Hartford, Connecticut. Okay, so what do? It's been a crazy 24 hours within the market. How do you position?
Yeah, that's the big question. It's so funny because actually I'm at our conference in Las Vegas, our Envestnet Elevate conference, and I was just on stage yesterday, literally as the pause was happening, telling everyone to stay the course. The timing was, madness, and kind of showing what had happened on Monday when we had, this false report of a reprieve. And stocks, skyrocketed only to come back down. And when you're a financial advisor trying to trade on this, it's absolutely impossible, of course. And so, the messaging then and now is, kind of you've got to stay put. I mean, certainly if you have clients who are not diversified and they're super concentrated, or, a lot of people let their equity positions get a little bit big in this hopes of a pro-growth, corporate type of policy from the administration. That's obviously all, kind of been obliterated. And now we're looking at a picture that's very different. And so you had people who are high in equities. If you're too high in equities, take some off the table for sure. But, these are the times that you need to ultimately stay the course and wait it out, or you turn the paper losses into a real loss.
Conference in Vegas. Nobody has conferences in like Sheboygan. They're always in Vegas or Miami or Scottsdale. Dana,
this is true.
I mean, they know what they're doing. Dana, so what about earnings here? I think, I have not seen earnings estimates really come down that much, but I've got companies left and right pulling their guidance and all that kind of stuff. How much earnings risk is out there, do you think?
Yeah, I mean, your last speaker said it, right? I mean, what's going to be crazy right now is you're going to have the first quarter earnings come out. You're going to have, March economic reports come out, and of course, all of these are going to paint this incredibly rosy picture that's not reality anymore, right? In fact, they'll probably be rosier even than they normally would have because you had folks, pulling forward consumption, pulling forward demand. And so things will look great. And you'll have this series of reports and this earnings season is going to be part of that. And so paying attention to that, of course, it gives you no information. It's really what is the guidance. And if you're a corporate planner, I'm not sure you can give great guidance, right? I mean, the volatility of, just what you have to potentially plan for in the short run. And then, if you're, some of the idea here, of course, is, hey, look, let's bring, some of the manufacturing back to the States. Let's kind of encourage people to have CapEx here. But how do you do a long-term plan? I mean, it takes years, right, to bring this stuff here.
Yeah.
How do you plan around that? So I think guidance is going to be probably overly, I'll almost say might likely be overly pessimistic because nobody really knows what they're dealing with.
Which to that point, Delta yesterday withdrew guidance, stock popped. Today, CarMax does something similar. I mean, it pulled back its financial goals because of the volatility, but same thing. And that stock's down 20%. So where are we in valuations?
Yeah, well, I mean, obviously we started the year very high. We've shaved a good piece of that, but that was part of the problem, right? We came into the year with that expectation of a bull market with high valuations as a start, not everywhere, but certainly as an index, right? In a market cap weighted basis, valuations were high. And so, when you come in with high valuations, really everything has to go well. And if you have this exogenous shock, and everybody knew tariffs were coming. It's not as though, this was entirely unexpected. And that's why you have that pull forward of consumption. But the magnitude, right, the breadth of it, how quickly it all was intended to come to pass, that did catch everybody off guard and, kind of wiped out that picture that rationalized those higher valuations that we were sitting with.
Dana, thank you so much for joining us. Always appreciate getting a few minutes of your time. Dana Dioria. She is Co-Chief Investment Officer at InvestNet, joining us from Hartford, Connecticut via that Zoom thing here.
Vegas, remember?
Oh, Vegas, that's right.
The
She's at
conference in
the
Vegas.
conference, exactly.
Yeah. Boom.
Boy, Vegas. There we go. S&P off 2.4% here today. The NASDAQ off 2.9%. So the sell-off continues after that reprieve yesterday. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Tariff turmoil still in the driver's seat for investors. S&P 500 down 130 points. This is a decline of 2.4%. The Dow Jones Industrial Average down 777 points. NASDAQ 100, 531 points lower. That is down 2.8% as the Magnificent Seven stocks swoon. NVIDIA, after yesterday's run up, down 3.4% right now. You have Tesla shares down 5.6%. Apple is down just about 3%. And after yesterday's rally, Citigroup advisors saying, don't chase this, don't buy the dip. CarMax pulling the time period it plans to achieve long-term targets. They're citing the potential impact of broader macro factors, including the tariff turmoil. As shares right now, they are lower. CarMax down close to 20%. The inflation data, inflation cooled broadly in March. CPI, when you strip out food and energy because they're so volatile, increasing just 0.1% from February, the least in 9 months. Deals in the work. Capgemini in advanced talks to acquire an outsourcing company, WNS Holdings. And according to the journal, WW International, the health and wellness company that we know as Weight Watchers, preparing to file bankruptcy. And you can guess why they're doing that. Blame Ozempic. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. Head over to youtube.com and search Bloomberg Podcast Live. That's where you'll find us. Busy times in the world of tariffs. We just had the European Union announce that they will pause metals counter tariffs against the U.S. for 90 days. Let's get the latest reporting from Europe. Kevin Whitelaw, Brussels Bureau Chief for Bloomberg News, joins us from the Brussels studio. Kevin, give us a sense of how Europe is thinking about trade with the U.S. these days. What are they doing with their tariffs? How are they perceiving the U.S. and tariffs these days?
Well, frankly, they're just trying to keep up at this point. Just yesterday, they had decided to approve some retaliatory steps that they were going to take against Trump's very first set of tariffs. Those were the ones on steel and aluminum. They approved this retaliation that had been well telegraphed, and then hours later, Trump pauses his newest one, which had been the so-called reciprocal level. So that extra level that was going to give the EU 20% across the board tariffs on their imports into the U.S. So they did pause their retaliation, said it was supposed to take effect in mid-April. They're going to pause it. That's what they decided today. They have been talking consistently all the way throughout about wanting negotiating space. They really don't want a trade war, and so they're trying to figure out what room there is for negotiation. They've been very clear they're happy to talk about tariffs and reducing tariffs to zero and on many things, industrial goods and cars and that kind of thing. But the Trump administration has made it clear that it's also talking about what it calls non-tariff barriers as well.
Mm-hmm. Who has, actually, better question first. Within the EU, are all the leaders in agreement on how to manage the situation?
They're mostly in agreement so far. So trade is a competency of the European Commission. So that really is very squarely something that Brussels is in charge of. But it still does need sort of sign off at times from the member states, or there are times where the member states could block things. And so other than Hungary, most member states have broadly been in the same place. I think there are some subtle differences, though, where there are some countries that are sort of getting ready to want to take a harder line on the U.S. at some point, Germany and France in particular, whereas you are seeing some other countries like Spain and Italy be a little more cautious about that, really want to try to keep the negotiations open and try to do everything they can to avoid a trade war.
So, Kevin, is the EU, are they going to send a delegation to D.C. to negotiate? Because we hear the administration saying how, up to 70 countries, are, kind of in line to kind of negotiate with the U.S. How is the EU handling it?
I mean, the EU has been eager to negotiate. They've been reaching out. Their trouble has been finding anyone to pick up the phone and take their meetings. And so, the EU trade chief Maros Sefcovic has been in D.C. He did meet with recently with the Commerce Secretary and the Trade Rep and the Treasury Secretary. He'd like to do that again, but at this point,
they're kind of waiting for someone to schedule some meetings and be there. The real problem I think the EU has, even beyond that, is it's not really clear whether Lutnick and Bessent and Greer are in a position to make a deal. So much of this is going to come down to Donald Trump. And as we've seen, he can seem like he's not interested in a deal one day, and then the bond market crashes, and suddenly he's talking about deals again. And so I think everyone's trying to understand what really is Trump's strategy with these tariffs here. Right. Is he looking for deals? Is he really trying to cut something? Or is he really talking about something that's a much longer-term structural thing that's going to be a feature of his entire administration, no matter the economic pain?
I mean, it definitely, from what he himself has said, it's the latter, but also instinct on when to change it. So that makes that a much more difficult interaction if you're the trade minister. Who has the upper hand then, just in terms of, say, good flows, trade balances, fiscal support?
Yeah, it's a really good question. I don't think there's a straightforward answer to it. I think on some level, Trump can throw around the weight of the American economy and some of that leverage there, and that can be a very effective weapon. On the European side, it does come. This fight comes at a more vulnerable time where the economies have been suffering a little bit. And, they're obviously reeling from a couple of different things. They're trying to figure out how to fill a bit of a void being left by the United States in Ukraine. They're trying to figure out how to, stimulate their economies, and they're lagging competitiveness. And so there is that concern. On the flip side of that, suddenly Europe is looking like a pretty reliable market that's got a pretty predictable set of rules that aren't about to change. And so, and they're going through what they think is a pretty effective, or they hope is going to be an effective effort to try to streamline and simplify some of the burdensome regulation. If they can do some of that, maybe down the line, the power of their single market is going to help them compete. But I think in the short to medium term, it's certainly an uncomfortable time for this fight to be happening.
What have we heard from the UK?
Yeah, good.
The UK has been in a slightly different situation, at least, in the reciprocal sort of tariff, numbers that Trump rolled out. The UK wasn't getting any extra penalty. So there's that baseline 10% was all that was going to hit the UK. They didn't, they weren't raised like the rest of the EU up to 20%. And Trump has so far been pretty happy about his relationship with the UK Prime Minister. But in reality, I'm not really sure that they're actually all that advantaged down the line. Mm-hmm. And if anything, I think it has raised a lot of interesting dynamics and opportunities for the UK and the EU to sort of get closer again.
Yeah, funny, because wasn't that whole split like 9 years ago? So there is that. The other distinction that many are citing is that Europe has a much greater bandwidth right now for more fiscal stimulus than the U.S. does, and I wonder if that gives it not better negotiating power, but a little bit more heft this time around than it did in the first Trump presidency.
I mean, the problem they have in Europe is that one or two countries have a lot of, have some room for fiscal stimulus, and Germany in particular does. So in that sense, you're right. But in other senses, there's countries that really don't. So Italy, Spain, Belgium, there's a bunch of countries that are pretty indebted and are already sort of violating or at risk of violating the EU's fiscal rules. And so you are going to see some extra spending around defense, but you're still not seeing from the European side yet this idea that they are really ready to embrace a broader set of common, joint debt to really, really ramp up either the defense transition or the clean tech transition. And so if at some point this fight gets to a certain place, you could see that it might drive that conversation and force that and maybe open that up. And that's the thing to be looking for. But right now, at least, we're not quite there.
Kevin, you're a graduate of Princeton University, so I have to ask this question. What is your go-to sandwich at Hoagie Haven?
Got to go cheesesteak every time.
There you go. See, everybody's got one.
What's yours?
Cheesesteak hoagie. No tomatoes, but everything else. It's the same order I've had since I was 12.
So what other options are there at the hoagie place?
Everything. And I don't think they've raised the prices since everything. Everything they've got there. And it's Hoagie Haven. It's got to be the best place on earth for sandwiches. Everybody's got their own. That's mine. But every Princeton graduate has got an answer to that question. You can't go to Princeton without being a diehard fan of Hoagie Haven. And Conti's Pizza as well.
He's nodding, by the way.
Kevin Whitelaw, Brussels Bureau Chief, Bloomberg News. He goes for the cheesesteak at Hoagie Haven in Princeton. S&P 500 off 150 points. That's 2.85%. We'll have more coming up. This is Bloomberg Good Morning.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Thursday, everybody. This is Alex Steele, Paul Sweeney, Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. So this was the week where we got CEOs putting out their investor letters. We heard earlier in the week from Jamie Dimon, and today we got Andy Jassy and his Amazon letter. Poonam Goyal is Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. Hey, Poonam, what did we learn from Andy Jassy's letter?
That startup, which means you never get off your feet. You know, you're always on your toes. And I think that's really what's helped Amazon thrive. It's just thinking, what next? Why?
So, I mean, just from the retail side of the business here, how do you think Amazon will deal with these tariffs here? I mean, do they just pass them along to consumers? Do they try to push some of that back onto the wholesalers? Do they take it in their profit margin? How do you think this is going to play out?
I think it's going to be a mix of everything. They remember on the Amazon business, the retail business, 60% or more of that is 3P. So that is where Amazon does not have the risk or need to figure out how they're going to deal with the added cost. On the 40% of the business, part of it is consumables. And consumables or food largely is insulated from the tariffs. So then that leaves us the discretionary part of the Amazon business. Amazon so far has said that they've halted shipments from China, given the very high tariffs that we're seeing there. We think they will not pass on the entire cost. We think they can shift the products that they sell. They can shift the sourcing where they source the products. But clearly, Amazon will continue to aim to be the low-priced retailer that we've known it to be, just like Walmart has said. They're not passing along the prices, right? They want to be low-priced. They're going to figure this out. And it's too early to still tell what really happens because, well, things are changing by the day.
Yep.
No, by the minute, really. Now, Amazon has also bet heavily on AI, and it's committed a lot of its $100 billion in planned CapEx this year to AI-related projects. Do we have a sense of if that is changing based on all the volatility and uncertainty?
So far, we don't think that is changing. A bulk of that was dedicated towards AWS, and we do think that the investments there are still needed. In fact, in our scenario analysis, we didn't expect that big of a drop in AWS momentum because if you think about the companies that are investing into cloud and into technology, most of the CapEx there is maintenance CapEx, right? You just kind of need it to stay alive. And then the incremental that's discretionary, sure, they can pull back on some of it, but likely not all of it.
So, Poonam, I kind of get the Walmart and the Amazon thing. They're so big that they can, deal with these tariffs probably. But how about everybody else in your retail universe? I mean, what are they saying here? I mean, it seems like it's going to hit in consumers' pocketbooks at some point.
It is. I mean, there's no way to avoid price increases. It really depends on how high these tariffs actually come out to be. So if you put China aside, which I think for my athleisure company, when you're talking about the Nikes of the world, they have 18% exposure to footwear in China, and they can mitigate that. They can say, okay, whatever we produce in China will be used for China and outside of the U.S., and then turn to Vietnam, where the tariffs are now lower, and the other countries to source product from there. Now, if you assume that 10% increase that's in place for the next 90 days, what does that mean to prices? We put together a model, and that means that prices will need to rise by roughly 6% if you only increase prices in the U.S. Nike can probably pass along a low single, mid-single digit price increase to its consumers on its high-value product. But on the low-value product, we expect them to tightly control the price increase there and keep it as low as possible because those consumers are more sensitive to price.
Is there a retailer that, makes all its stuff here in the U.S. and then will be just totally not exposed?
Makes all its stuff in the U.S. And no, not when it comes to footwear and apparel. That is very difficult.
So what would it take to you guys see this meme going around? It was like a video, an AI video showing regular U.S. people putting together a shirt or stringing together a sneaker and that kind of thing. Would putting up a plant in a factory here to make shoes or to make a shirt, is that realistic?
No, not at all. We cannot make all the footwear and apparel that we consume in the U.S. Number one, we don't have the factories, and number two, we don't have the seamstresses and the talent to do so. So unless we're importing in a bunch of people to do this and then putting out the capital to build these factories, which that itself could take years, it's something that we just cannot do.
All right, Poonam, thank you so much. We appreciate it. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst for Bloomberg Intelligence. Looking at these markets here, they're kind of rolling over a little bit here, Alex. We got the S&P now off 3.1%. The Dow's off 1,052 points. That's 2.6%. The NASDAQ off 635 points, 3.7%. So seeing a kind of a continued weakness in this market here today. It kind of calls into question yesterday's rally a little bit.
I mean, the notes seem to be circulating that the total crash threat is off the table, but this is still a kick the can down the road. And Charlie McGallagher over at Nomura was just saying, like, well, what happens in 89 days from now?
Right.
Are we going to be in exactly the same kind of place? Plus, if you take a look at the back end, I'm continually surprised at how little the back end moved yesterday and today, considering the massive run up in yields that we saw over the previous couple days. And until that comes down, is that going to really inhibit risk on sentiment?
Yep. And, you look at the earnings estimates out there for the S&P 500. Analysts have not really brought the estimates down. And, again, the consensus is for about 10%, 11% earnings growth in S&P 500 earnings for 2025. We've had some people come in here and say that could be flat, and that's a big difference. And maybe that's been priced in, but we haven't seen it necessarily in the numbers. Maybe the market's ahead of where the analysts are. We'll have to see where that plays out. But I think that's uncertainty level, if you look at today's action, remains.
All right. Well, for our listeners in the U.S., reminder, go ahead and listen to us via satellite radio, Sirius XM channel 121, 24 hours a day. Bloomberg Radio, Sirius XM channel 121, brought to you by Oracle.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday to me and Paul. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks, and we have them lined up for you today. Nathan Dean of Bloomberg Intelligence will be breaking down the last 12 hours in D.C. and that policy reset. Deborah Aiken will be here to talk about Prada agreeing to buy Versace. Then Jen Bartashis, Bloomberg Intelligence Senior Analyst in Retail Staples, will be talking about Walmart and egg prices. Yeah, let's get into it. And then Barry Ritholtz is here as well, what his take is on the last couple days and how do you position yourself. And finally, Ken Shea, Bloomberg Intelligence on Constellation brands and what that means for tequila and wine sales, which apparently are still holding up, by the way.
No surprise there.
It's all helped by Paul Sweeney.
Yeah,
so let's kick it all off for you right now with the Bloomberg Business Flash. And for that, we go to Charlie Pellet.
Hi, thank you very much. Quite an hour coming up right here on Bloomberg Intelligence. We've got stocks selling off, not just lower right now, but in fact lows of the morning on the S&P 500 index down 175. Yesterday, you recall the S&P surged 9.5%. Right now, that index is down 3.2%. The Dow, though, down 1,068, a drop now of 2.6%. The NASDAQ Composite Index is down 3.9%, down 660 points. The 10-year at 4.32%, with the 2-year currently yielding 3.80%. Gold up $75 the ounce, $31.58. Gold, the precious metal, up another 2.4%. And West Texas Intermediate crude now down 5% with a 59 handle WTI, 59.22 a barrel. Again, bears repeating, we got crude selling off by 5%. Earnings season kicks off in earnest tomorrow morning when we hear from J.P. Morgan Chase, Wells Fargo, and Morgan Stanley. Dana Dioria is Co-Chief Investment Officer at Envestnet. And right here on Bloomberg Intelligence last hour, she told us the broader earnings picture may prove to be deceptive because of the uncertainty over tariffs.
What's going to be crazy right now is you're going to have the first quarter earnings come out. You're going to have, March economic reports come out. And of course, all of these are going to paint this incredibly rosy picture that's not reality anymore, right? In fact, they'll probably be rosier even than they normally would have because you had folks, pulling forward consumption, pulling forward demand. And so things will look great.
Dana Dioria of Investnet talking to us from Las Vegas. Speaking of earnings, CarMax backing away from the timing of its financial goals, joining a growing list of companies indicating that uncertainty around President Trump's trade war is making long-term planning difficult. KMX on the ticker, and right now it is down by 19.9%. Again, recapping lows of the morning on the S&P 500 index, with the S&P down now by 3.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We are live in our Bloomberg Interactive Broker Studio in New York City. We are streaming live on YouTube as well, so you can head over to youtube.com, search Bloomberg Podcast Live. That's where you'll find us. As Charlie was just reporting, a pretty broad sell-off here in the equity markets today. Let's see where the action is under the hood. We can do that with Denitsa Sekova, cross-asset reporter for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. Denitsa, what are you looking at today?
Let's start with the United States Steel. We saw a drop as much as 10% earlier today. Now some of the losses are fading. Still a very bad day for the company. It comes after President Trump said he doesn't want to see the steelmaker owned by a Japanese company. Of course, there has been so much back and forth with the supposed acquisition of Nippon Steel. President Trump has repeatedly said no to wholly owning the company, but he has been open to investments in the past. But what we heard now is that he pointed to the producers' rising steel orders as evidence that it doesn't need any investment right now. He actually said if we go back to U.S. Steel from 90 years ago, it was incredible. So there is a lot of optimism for the orders there. We saw a 16% jump earlier when things seem to be moving in terms of that acquisitions, but now we're seeing a big drop year to date. The stock is doing okay.
Yeah, and there's a lot of debate on, like, will U.S. Steel be okay? I mean, a lot of analysts say, like, yeah, they'll be all right at the end of the day. Let's go to Nike. Oh, my gosh. The whippiness of these shares was crazy. You get the stock now down by 10% despite this tariff pause.
Yeah, every morning I go and look at Nike because I think for
That's
me,
a fair point.
Yeah, I think it's the proxy of where the sentiment on tariffs is. We saw a massive gain yesterday, big drop today, as we said. It's kind of become a symbol of that corporate fallout from tariffs. Yesterday, we obviously had the pause for 90 days. We saw a massive rally. In many retail brands, we saw Lululemon, we saw Walmart, but now as those news are setting in, as people are worried about recessions, as people are worried that still some of the tariffs are on the table, Nike is really suffering. Of course, its supply chain is being specifically threatened. We have some stats that about half of their production is actually coming from Vietnam, which is one of the countries that U.S. has been actively negotiating with, and it seems like things have looked better. But obviously, over the past 30 years, we have a great story on the terminal that Nike has invested billions of dollars in production in Vietnam, and now obviously that's being threatened. The stock is down nearly 30% year to date. Even yesterday's rally couldn't lift it up enough to improve that.
Constellation Brands, Booz, what's happening?
Yeah, but it's up on the day. It's coming off the news of downbeat guidance because of the tariffs. Of course, analysts are even saying that they're surprised they offer guidance at all. And what they offered is kind of optimistic. From what we're seeing today, yet we're up on the news. Of course, this comes like an overall climate for drinking, as alcohol companies haven't been doing so well, as younger generations have been opting for non-alcoholic drinks and kind of healthier alternative, have been more health conscious. So there has been this big theme of people shrugging those brands. Of course, the big issue with Constellation is that it's importing popular Mexican beers, and with the trade war, that can obviously be hit very hard.
Yeah, and that's not going to be good for that company at the end of the day. Okay, great. Thank you so much. We really appreciate it. Denitsa Sekova joining us, Bloomberg, a cross-asset reporter. For more conversations like this, go ahead and listen to Stock Movers podcast and subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. All right, well, we were debating in the last hour, like if John Tucker is Versace and Michael McKee is Prada.
Right.
Now they're going to be uniting. So it's like a Mike Tucker kind of
I see what's
Prada
happening.
Versace
Okay.
thing. All right, Deborah Aitken, Bloomberg Intelligence luxury goods analyst, joins us now. It's funny because neither of them are those things. So Prada is going to buy Versace for about $1.38 billion. Walk us through the intricacies of this deal.
Hi. Yeah, it's been talked about for quite a while, and we already last night heard maybe that the acquisition price would be down by a couple of $100 million. The big thing here has been that under Capri, Versace has not had enough investment in it over the last year, particularly in the field of the tapestry bid for Capri, which didn't go ahead. And which took a lot of the headlines last year, and where all brands under the Capri banner suffered. We've had Chairman John Idol come back into the business as CEO for Capri, and with the focus really on Michael Kors, which is 70% of the sales. And after a difficult year last year, 100% of the profitability of the company leading into this year. So it's all about turning around Michael Kors, which has 70% of its business in Americas, is at accessible price point, and where actually we think that there'll be much more pressure given the tariff situation and the cost of living on all consumers, and also in the US. If we turn over to the Versace acquisition, and what's going on there with Prada. Prada has been one of the top performing companies. It's really done ever so well with Prada for the last few years and gone to normalized single-digit growth. And then it has a brand, Miu Miu, within its portfolio, doing ever so well. It's #1 on the list index for luxury brands in terms of brand equity, brand heat, with Prada at #3. And during the December quarter, Versace dropped 3 places to #14. So we think it shifts Versace into the right hands, into Italian luxury owners who can really work well to try to reinvigorate this brand and the brand equity behind Versace.
Right. Hey, Deb, I'm really interested in the valuation here, being a former banker myself. They're selling this thing for $1.38 billion US dollars. In 2018, they paid $2 billion for this. So a lot of value destruction. Is that a Versace specific issue, or does that reflect lower valuations in luxury generally?
I would say it's both, but it's mostly Versace specific, because if we look at the size of Versace then to now, the fact that it's given double-digit declines in organic sales growth through the couple of years where actually the market was growing 5% or so, and that 1.7, to put it into perspective on an EV, would have been against traditionally a market for a very solid brand, Versace, with a lot of heritage, running from anywhere from 3 to 5 times, probably 3 times for Versace, given it isn't particularly big, under the what was Michael Kors and then became the Capri group. The expectation was that they would run it from 1 billion in sales toward 2 billion, and that just didn't happen.
Right.
Yeah, so that's partly why. I think also because of the state of the market, we started 2025 with the luxury market focusing for low to mid single-digit growth. With everything that's going on, we pull that back towards neutral.
Hey, Deb, thanks for joining us. Always appreciate getting your thoughts there. Deb Aitken, the leading voice on all things luxury. She is a luxury goods analyst for Bloomberg Intelligence. She's based in London. Got a red headline coming across the Bloomberg terminal. House adopts plan to advance Trump tax cut debt ceiling hike. So maybe some movement there. And whenever we talk D.C., we talk D.C. policy, we talk to Nathan Dean. He's senior policy analyst for Bloomberg Intelligence. He's based down there in Washington, D.C. We banished him to D.C. He's down there. Nathan, talk to us about this news coming across, about just kind of what we want to see from, or what the House would like to do in terms of the tax cut, the debt ceiling, all that type of stuff.
Yeah, so this is a big win for Speaker Mike Johnson. Essentially what this does is this allows Republicans to move forward and begin the specific negotiations on how they're going to extend the Trump-era tax cuts, and then subsequently what are they going to cut to try and offset some of that expansion, whether that's Medicaid, the Inflation Reduction Act, and SNAP benefits. Now, the fact that the House passed this resolution is fairly significant, allows the momentum to keep going. But the question that I have that we'll likely find from Bloomberg News later today is, what did Speaker Johnson have to do to get those hesitant Republicans on board? Because, you know, right before I came on the air, he was huddling with a lot of the moderate Republicans on the House floor. I want to find out what he had to do in order to get that deal to move forward. But again, it's a big win for the Trump administration because now they can spend the next few months trying to come up with those specifics. We've always told our clients that we think this is eventually going to happen, that there is going to be a deal, but the question that still remains is, will this deal increase the deficit? I think so, fairly likely. And what gets cut to extend these tax cuts? And we don't think it's going to be all that much, assuming that they move forward with the plan that they're adopting right now.
Okay, so to that point, is this the House version of the Senate bill that passed last weekend, or is this their own version that now they go discuss with the Senate?
No, so this is the House adoption of the Senate resolution. Now, if you remember, you know, in order to pay for these Trump-era tax cuts, you're looking for around $4.6 trillion. Now, what the Senate did is they're essentially assuming that's current policy and that's baseline, which means that the cost of it is essentially zero. Now, the Senate also included $4 billion with a B, in terms of estimated cuts, which they call is a floor. The House problem is that the House was looking for around $1.5 trillion with a T in terms of cuts. So now the question goes, okay, well, if the Republicans are now pursuing $4 billion with a floor, with the idea that it could go further, you know, are they essentially going to agree on a deal that doesn't cut much, therefore increases the deficit fairly significantly, assuming you don't get enough economic growth to pay for it? Or do the House Republicans, who are insisting on trying to do more cuts, hold out to the end when they realize that cuts to Medicaid, the IRA, and SNAP benefits are just too difficult to actually stomach, and they'd rather just kick the can and go for the easy solution?
All right, I'm all for the easy solution in my life. Nathan, so why don't we just, let's be clear. It looks like they're going to pass this thing. Tax cuts are going to be extended, and we'll just add to our national debt. Isn't that kind of what's probably going to happen?
Well, you know, there's two things that are coming up. One is the timing of this. I mean, look, they don't have to do anything here until the end of the year, December 31st. But this does include a $5 billion increase in the debt ceiling. And according to Treasury, you know, that X date is probably going to be sometime in July and August, suggesting that this plan will have to pass in addition to that. But to your question about the deficit, the real big question we have here is that what additional tax extensions or, tax cuts come in this? The Senate plan had $1.5 trillion in additional tax cuts. Think when Scott Bessent, the Treasury Secretary, says no taxes on tips, no taxes on overtime, and so forth. Is that enough stimulus to essentially allow the economy to regenerate some of the momentum that it's lost over the last few days? You know, it's still a question to be decided. So there's a lot of time left for the specifics to have to play out. You know, we think this is going to probably go until June at the earliest, September at the latest. So, you know, we have a lot of time to prepare for this. But again, Congress is doing the easy thing right now. They're waiting for the difficult times and the more specific times to come later.
But I wonder if there's a greater sense of urgency now that we've had this market turmoil on the equity and the bond side, and those don't seem to be dying down irrespective of yesterday's move. It's like, get the good stuff out.
Yeah, absolutely. I mean, if you think about the good stuff that the Trump administration is promising for business, it's this idea of tax extensions and also deregulation. You know, we saw last night an executive order, if you will, calling on regulators to essentially bypass, it's a little wonky here, the thing called the Administrative Procedure Act, where they can essentially say, you know what, let's just go deregulate and say it's done. Normally you have to have a comment period, a process, and it takes like about a year. So I think there is some urgency going on at the White House that in response to what we've seen over the last couple of days to get that good news out. The problem for the good news on the tax debate is that it is going to take time to get all these Republicans on board, because as we just saw, it was a challenge just to get the Republicans to vote for the blueprint. It's going to be an even greater challenge when they see what the economic and the actual impacts of these policies will be.
30 seconds here. Did the president win yesterday, or did he put the 90-day
30 seconds,
things,
that's just harsh.
or was it just bowing to the market?
I think the president gave the markets breathing room. I mean, the situation hasn't really changed. In 90 days, these tariffs potentially could come back, but I think the president gave the market breathing room so they could develop a bigger strategy that may be a little bit more susceptible to having Wall Street view them in a more favorable light.
You know who didn't win at all? the shorts in the equity market. They lost hard pretty much all across the board. Hey, Nathan, really appreciate it. Nathan Dean, Bloomberg Intelligence, a senior policy analyst, joining us there. All right, coming up, we're going to take a look at the broader markets here with Lara Castleton, a U.S. head of portfolio construction and strategy at Janice Henderson, and Jen Bartashis of Bloomberg Intelligence will be joining us on retail and food prices. I told you, nationwide, prices of eggs are coming down. She will give us the lowdown. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. President Trump's tariffs on Chinese imports are now at least 145%. That includes both a 125% rate that covers reciprocal duties as well as levies imposed on China for retaliating against U.S. import taxes. This according to a White House memo. It also encompasses a 20% rate imposed by Trump earlier this year over fentanyl trafficking. Stocks are lower. The Dow, the S&P, NASDAQ, all in the red right now, with the S&P down 186 points. Low of the morning, down 3.4%. The S&P now at 5271. The Dow is at 39,489, down 1,119 points, down 2.8%. And NASDAQ is down 702 points, down 4.1%. The 10-year at 4.33%, with the 2-year currently yielding 3.79%. Spot gold now at $31.64 the ounce, up 2.7%. West Texas Intermediate crude down 4.3%, $59.65 a barrel. And Bitcoin down 3.3%, 80,390 on Bitcoin. Amazon CEO Andy Jassy, in a note to shareholders, his annual letter says the company must operate like the world's largest startup to meet demand for artificial intelligence and reduce bureaucracy. Again, recapping, the sell-off continues today on Wall Street, with the S&P after yesterday's rally down 3.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. To our worldwide audience out there, we're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us there. All right, here's my Janus story. The first time I ever went to a Starbucks, like 20 years ago, was waiting to go into a meeting at Janus out in Denver, Colorado. I'm not a coffee guy, so I had no idea what to order, so I just ordered what the person in front of me ordered. There you go. That's my Janus story. Laura Castleton joins us, U.S. Head of Portfolio Construction and Strategy at Janus Henderson, based in Denver. Laura, you sit back and you think about portfolio construction and strategy. How do you do that with this volatility that we're dealing with this year?
Well, thank you for having me. There's a couple more Starbucks that have popped up over since I'm sure you were here. Yeah, there's a little bit of volatility going on in the market, making our conversations a lot more in demand, you should say. Very clearly, planning long-term is what we need to be focused on for our clients. Near-term volatility is very extremely difficult. Heading into the tariff announcement a couple weeks ago, we were talking to clients about really staying the course, not panicking, but being more diversified than what we had maybe been in the past.
What does diversified mean? And I know that's a stupid question, but I say that and you look at the 30-year. If I own the 30-year for diversification, I just got burned.
Correct. So on diversification, what we're talking about in our client consultations, it's diversification of that typical 60-40 portfolio, absolutely. But then it's also diversification within the 60 and within the 40. And when we actually survey, so we've worked with over 25,000 model portfolios, over 6,500 clients globally, and recently came out with a piece just kind of isolating the average moderate portfolio that we come across. One of the biggest topics of conversation we're talking about right now today is actually the diversification within the U.S. equity allocation, because that concentration's reached north of 80% of investor portfolios. So it's not just across assets, but it's also within.
Hey, Laura, how about international markets? You know, in the first quarter, the rest of the world's markets really outperformed the U.S., the S&P 500. And that doesn't happen very often. Is that kind of a short-term blip, or is that something that we need to, think about longer term?
That's a very good question. It was very interesting to me to actually get some incoming calls from clients asking about international, because to your point, that has never happened before. I do believe with the tariff policy that's come in, obviously we don't know what's going to happen long term, but it is signaling a structural shift in what we're trying to accomplish longer term with our budget deficits. To me, that does warrant potentially diversifying away from only the US dollar. And so while international markets have been strong this year, there's a shift in how they're spending abroad. They're stimulating their economies, and that warrants having some diversification only outside of just only that heavy concentration of the US dollar.
What do you expect in terms of this volatility? Like, clearly diversification is good for all. I mean, the idea is that it should be good for all investing climates. However, the longer the volatility goes on, the harder it is for investors to stomach that.
Absolutely. So that's exactly what we're coaching our clients through, is very clearly, even in the past week, if you wanted to make some pretty big bets on going into certain areas of the market, let's talk even fixed income markets, you could easily get whipsawed the next day, the next week. And so when you're talking about diversification, you need to be spread across the yield curve, across sectors within fixed income, across regions within equities, and you should start to see some bounces from some of these other areas while other parts of your portfolio are kind of dipping. So we're really talking about staying towards that long-term goal. And luckily, a lot of the clients that we work with are managing money for clients that have a long-term financial plan. So while they're getting headlines every day about the volatility, for the most part, they're being able to coach their clients that volatility happens. This is not outside of the norm, but on a long-term basis that you're still well within your reach of your goals.
Laura, are the folks at Janus Henderson, are you guys, is your base case a recession, or maybe we can skirt past it?
So base case is not recession. That obviously has been coming up into conversations quite a bit more. So it's not out of the picture this year. And remember, before the tariff announcements, growth was already slowing. There was already that lack of confidence within the economy that could bleed into slower growth, leading to a recession this year. So it's not without of the realm of possibilities, but it's not a base case. And it's also not necessarily a doomsday scenario for portfolios. Recessions happen. It doesn't necessarily mean it will be the exact recession we experienced the past 2 times, which were quite severe. And there are ways to plan around that, namely be high quality within your names, focus on the fundamentals within your company balance sheets, and within fixed income, really shore up the quality in your fixed income portfolios as well.
Before I let you go, corporate credit, spreads have blown out. They're continuing to blow out, particularly in high yield. Does corporate credit play a role here?
Yeah, that was one of our biggest overweights we saw in a lot of client portfolios leading into these events, was the heavy allocation to corporate credit, and really one direction spreads could go was wide. We've started to see that, although they've maybe started to trickle back in a little bit. That is still an ongoing risk and easily avoidable in our minds to be diversified across yield curve. So on the shorter end of the corporate credit spread curve, you do get a little bit more insulation from spreads widening. And then within the securitized area of the market, spreads were already a little bit wider. We were able to insulate ourselves from that area by hiding into securitized, but corporate credits are typically that canary in the coal mine, and it's something to watch for that recession indicator going forward.
All right, Laura, thank you so much for joining us. Laura Castleton, U.S. Head of Portfolio Construction and Strategy, Janus Henderson Investors, out there in Denver, Colorado. Great offices out there, great firm. Actually, it was, when I was on the sell side, it was the biggest account in Denver. You had to get the vote from Janus, and I did. All right, let's talk retail here. We talked Jen Bartash, she covers all the retailers for Bloomberg Intelligence. I'm going to talk Walmart here, because Jen, so goes Walmart, so goes, it feels to me, kind of just the overall retail environment. What's Walmart saying these days about its ability to pass along price increases to its customers, or do they take it in their maybe some lower margins?
Yeah, it's a good question, Paul. Walmart just had their investor day, and obviously tariffs were a large topic that management had to address. With Walmart, historically, they have such scale that they're really able to leverage that with their suppliers to try to negotiate lower prices, and they might have more of an advantage than some of the smaller retailers out there. At the same time, because they have such a diversified set of products, so if you think about it, as you know, Paul, Walmart is the biggest food retailer in the United States.
I know. Thanks to you.
Over 50% of the revenue comes from just groceries. So their exposure to general merchandise is already a little bit lower, and not all of that is sourced from overseas. So their ability to offset tariffs without cutting into margin is probably better than a lot of other retailers that we're looking at right now.
How do they, okay, is it just scale, the power of scale that they have these agreements? And then at some point, how does that negotiation unfold?
It is, Alex, to your question, a bit. It's about scale because they order such huge volumes, and they order in advance, that for their partners, there is some security in that, knowing what your orders are going to be and being able to plan appropriately. But at the same time, because they have such a diversified operation, they can spread out cost across it pretty effectively. So it's a combination of those two tactics that really will help them mitigate any of the impact from tariffs that we're seeing.
How about everybody else.
Yeah, I was going to say that feels like that's bad news for literally everyone else.
Yeah, I mean, how about everybody else? How do you think this is going to play out?
Well, I think what we're looking at is, especially for retailers with a high exposure to China specifically, given yesterday's announcement of the 90-day pause and, room for negotiation, I'm really focusing in on companies that have a higher exposure to China. That includes companies like Dollar Tree, that includes Five Below, and it also includes Target. And for those companies, what they all have in common is that they sell a lot more discretionary goods. And especially in the dollar store segment, you're talking about low price point goods where there's a lot less room to be able to raise prices without really disrupting your customers. And so those are the companies that we're looking at right now that really have the greatest exposure and have the highest difficulty in being able to manage through the tariff situation.
Hang on a sec. Cat and Jack stuff from Target is made in China?
Yeah.
Stop. Mind blown. This is where you go and you get your super cheap, like my daughter's going to grow out of this in 4 minutes, but it's still a cute t-shirt thing.
Right.
Wow, interesting.
Well, what I'll say about Target is they've done a really good job in the last 3 or 4 years of diversifying away from China. So they still have exposure to China, but it's not nearly what it was, say, back in 2017. So they've expanded into Cambodia, to India, to Vietnam, to other countries, which, and with the current pause in tariffs, is probably a big sigh of relief for Target because they have done that diversification effort.
Yeah. All right. Jen, thanks so much for joining us. Jen Bartashis, Senior Retail Staples and Packaged Goods Analyst at Bloomberg Intelligence, joining us from Princeton, New Jersey via the Zoom thing. I guess if you're a Walmart, you're an Amazon, boy, this scale really is going to pay off in this environment.
Yeah, I know. But what about the small,
I know. I'm thinking about the mom and pops in my town, the toy store, the card store. I don't know what those folks are going to do. Particularly at the lower price points, as Jen was saying.
I have a friend who sells yarn for macrame, and she placed an order yesterday because the tariffs were put on pause, and she's like, either this was a great decision or I'm going to go bankrupt. Like this is a completely binary situation. And she runs like a small business out of her house. Like it's that kind of situation that many people actually do. All right, coming up, we are going to break down these markets more with Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business. He always has opinionated things to say, and I'm sure he will not disappoint. You're looking at an S&P almost off by 4% now. We're down by about 210 points. The NASDAQ off by almost 5%. Paul, we have seen this movie before. The VIX now back up to 42. And that long end, very sticky higher, up again another 7 basis points on the 30-year.
Yeah, exactly. I'm looking at the 2-year down 12 basis points. So big changes in this shape of the yield curve. One more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Another leg lower. In fact, lows of the session again on the S&P 500 index. Down 213 points now, down 3.9%. Dow Industrials lower by 1,330 points on the Dow. A drop right now of 3.3%. While the NASDAQ Composite Index is slumping 785 points. For NASDAQ, a drop right now of 4.6%. Broad-based selling. Russell 2000 index lower now by 4.9%. The 10-year at 4.34%, the 2-year 3.79%. Gold is surging $90 the ounce, up another 2.9%. Spot gold at $31.73. West Texas Intermediate crude right around $60 a barrel, was trading below that number. Right now, WTI 60.30. It is down 3.3%. The Consumer Price Index dropped for the first time in nearly 5 years. And with that story, here's Bloomberg's Vinny Del Giudice.
The surprise U.S. inflation data covering March show lower costs for energy, used cars, auto insurance, hotel stays, and airfares. Even with some U.S. tariffs already in place, the cost of some goods typically assembled in China were down. We're talking toys, appliances, and tools. Grocery prices were up, though, and egg costs once again ran high, as did meat prices. Looking ahead, the Federal Reserve is worried about the impact of tariffs. Vinny Del Giudice, Bloomberg Radio.
Prada has agreed to buy Versace for about $1.38 billion in cash, strengthening its position as Italy's largest fashion group by adding one of the luxury industry's best-known brands. Prada is buying Versace from Capri Holdings, which paid $2 billion for the brand in 2018. Capri's brands, by the way, include Michael Kors and Jimmy Choo. Right now, ADRs of Prada, they're surging 7.7%. Capri, though, down 9.7%. Recapping, stocks moving lower. Lows of the session now with the S&P today down 3.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, Tom from the Upper East Side writes in and says, I want to talk about volatility. He likes to call out the VIX for the equity market, 42. That's big time elevated. How about the MOVE index? That's also spiking over the last couple of days. Let's check with Barry Ritholtz, see how he thinks about it. Barry Ritholtz is a host of Masters in Business on Bloomberg Radio. He's also the founder of Ritholtz Wealth Management. Hey, Barry, whether you're looking at the equity markets or the bond markets, volatility is the name of the game, and maybe the volatility and the spike in yields over the past 36 hours moved our president to maybe rethink some tariff strategies here. How do you think about volatility in both stocks and bonds?
So, such an interesting question. Let's unpack it in pieces. The volatility we've seen in stocks was really the equity markets adjusting to the impact of tariffs, lowering revenue for companies, reducing consumer spending, at the very least, reducing the growth rate from a GDP of, plus 2.5%, 3% to plus 0.5%, plus 1%, maybe even negative if you believe the Atlanta Fed GDP Now data, minus 2 or 3%. But the bond market reflects something completely different. And what you normally see during a sell-off in equities, you see a rally in bonds as money rotates. I think what we've seen over the past few days, when you see yields spike at the same time there's a massive sell-off in equities, that's telling us not that people are selling stocks or bonds, they're selling dollars. They're getting out of dollar-denominated assets and repatriating their capital. And anybody who understands the fixed income markets and the power of the dollar as the reserve currency says that is very distressing. That is very worrying. If someone were to say to me, what do you think motivated the president to go on this 90-day hiatus? Was it the stock market or the bond market? I'm going to tell them it was the dollar market. That's what moved him. So volatility is just a function of this giant shift in economic expectations and where we're going to be 3 or 6 months from now relative to the new policies.
Is that what's going on with the back end of the bond market and why that those yields just do not seem to want to come down right now?
Yeah, so when you look around the world and you look at the Pax Americana we've enjoyed since the post-World War II era, we send people our paper. We get to print paper. Hey, here's an IOU. And they send us goods and services. I think that's a fantastic deal, as do most traditional economists and fund managers and policymakers. This is very much an outlier strategy, an outlier policy that we haven't really seen implemented. You know, it's 100 years. You got to go back to 1930. So when you see the funky activity in the way both bonds are trading, the way spreads are widening, not tightening, and the way money is moving around the world, it kind of looks like other countries are battening down the hatches. Hey, there's a storm coming. Let's everybody bring in come on in. There's a lightning storm out there. Get off the baseball field. Bring your cash and your assets with you. There's a little bit of doomer prep going on in capitals around the world, because not only are the goals and end of the tariff policy not well understood, this was kind of rolled out in a very big-footed way. You know, the Fed is so communicative about what they're going to do. Hey, we're raising rates in a couple of meetings. Hey, here are the metrics we're looking at. All right, we're getting closer. We're going to raise rates. All right, here's the press conference. We raise rates. Oh, and by the way, here are the minutes of our meeting. So the markets are very used to that. Suddenly, April 2nd, here's what we're doing, and it's giant tariffs. None of the market participants expected something that radical, and it rattled them.
So what do we do here? What are you suggesting to your clients here? Because we've got, again, the market rolling over again today.
So, you know, a lot of times it's always fascinating to see the reaction to these things. A lot of times when you have a very rapid sell-off, hey, that rubber band gets stretched too tight in one direction, and it doesn't take a whole lot to cause, you know, all right, we're going to make up a third, a quarter, a half of those losses. We saw it following September 11th. We've seen it in other major sell-offs. Look at the pandemic. So what we've been telling clients are, hey, unless you really need this money in 6, 12, 18 months, if you're contributing to your 5-year-old's 529 and you don't need this, you know, for a dozen years for college or 401k, a retirement plan in 10, 15 years, you'll be fine on the other side of this. The challenge is for people who are going to need this money over the next 6, 12, 18 months. If they're about to retire, nobody likes to hear, maybe you might want to hold off a year or two, but it really depends on their specific situation. The volatility we're seeing, what makes this so unique is that we're not looking at pandemics or profits or any of the other, or even sentiment. We're not looking at the usual metrics. We're looking at the, I don't want to be blasé and say whims, but we're looking at the thought process of one individual who we have seen tends to be spontaneous, improvs a lot, kind of mercurial. It's really impossible to predict what's going to happen when it's so dependent on simply the desires and whims of a single individual. It's kind of unprecedented when you look at market history. I mean, I have to go back to the Iraq War or World War II to see, you know, how much a market's going to turn on what Churchill said in the UK or what Roosevelt said here. Even then, it's just so rare to see it so dependent on the moods of just one person.
Not the moods, instinct, as he mentioned yesterday. Instinct, that's what he's going for. All right, Barry, thanks a lot. We really appreciate it. Barry Ritholtz, founder of Ritholtz Wealth Management and host of Masters in Business. Definitely check out his weekly podcast as well. Coming up, Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst, will be joining us on Constellation and how costs may jump from 25% beer import tariff. We're going to get the breakdown on that in just a moment. S&P extending its decline to more than 4%. This is Bloomberg.